All right, yo, what is up for y'all watching this on the YouTube replay? I hope you are having a great day. Let me start this off with a quick portfolio update and an update that we're going to be live in exactly 8 hours and 30 minutes from right now. It says 11:33 a.m. for me. At 8 p.m. we're going to be live streaming, and that's when the market opens, so we'll kind of see how stocks move. I believe next week there's only 2 full trading days, so next week is going to be really short because it's Thanksgiving week. But yeah, let me give you a quick portfolio update, show you how we're doing, and then I'll get into some stocks that I think are very attractive right now. Like Uber looks like a steal of a deal. So yeah, this past week we weren't doing too well in this is known as our dividend-only account, where every stock in here, of course, pays a dividend. We're up 11.8% year to date. Let's actually go check the S&P real quick, or just this account, but we're up 11.8%. The S&P is up 12%, so we have just slightly underperformed the S&P 500. Here are all the stocks that we own in here, and here's my lifetime percent change on them. The only stock we're down on is Carlyle Group. So yeah, there's that one there. And then we have a Roth IRA as well, basically tax-free retirement account. Started this basically a year ago, and it also has not done too well. We're actually negative 1% year to date. I've just done so many changes in here. I've been in so many different speculative risky stocks that I've kind of just narrowed it down finally to a portfolio that I'm happy with, the 5 stocks. I'm actually maybe looking to buy more Webull if they dip, but right now, the thing is with Webull, why wouldn't it have this one as a major size position? It's worth owning a little bit, but not a lot of it. It's roughly fairly valued at $8. They're trading in my generous estimates about like 34 times next, well, not even like maybe next 2 years out multiple. So they're fairly valued on Webull, but I really love that stock, and I'm more bullish than the analysts are. And then we have our Webull portfolio. Hey, what up, Tommy? What up, Looney? Good to see you. I hope you're having a great Sunday. Yeah, this is our Webull account where it's just our risk on portfolio. Definitely underperformed. We're only up 8.6% all time. And we just like last week or the week before, we were up like 25% all time. And we've lost a lot of value here because we're in a lot of growthy type risky names. So yeah, we have some winners and some big losers in there like Sprouts Farmers, Zoom. And then we have our Moomoo portfolio where once I buy a stock in here, I try and never sell it. It's in the top left corner, buy, never sell account. And these are all the stocks that I've chosen in here. But in this portfolio, this has been our insanely performing one. Year to date, we are up 70%. So we've done fantastic, versus the S&P. We were doing just as bad as the market though during April. We were down 14% worse. We were down more than the S&P 500, but now we're up 70% versus the S&P up 12. And that's mainly just from our boring buy and hold strategy. But the reason we're doing so well year to date is because I wasn't taking profits before today. Like most people, when they get their first double on a stock or triple or something, they'll want to trim their position, take some money off the table, which is could always be smart. But you don't want to trim out of high quality companies. So, hey, what up? In he said Duolingo stock. Yeah, if you guys got any stocks you want to look at, let me know. We'll look at a few of y'all. And I have some I want to recommend. Like, I really think Uber is a really good deal right here. But yeah, here's Duolingo right here. This is that language learning app. You go to Duolingo to learn a language. And one reason why Duolingo stock is getting crushed is because of the AI replacement thesis. Like OpenAI, which is ChatGPT, but the parent company OpenAI just made a language learning app competitor where you can learn a language and you don't have to pay for Duolingo subscription, because Duolingo is a subscription model company. They make a bunch of money from that. This is why I would look into buying the dip on Duolingo, because their numbers are still phenomenal. It's just the future uncertainty why the PE is collapsing right now, but I think the risk reward actually looks really good because their numbers are so good. So 85% of the revenue is their subscription business. The growth is nuts. It's up 45%, after grew 48%, after grew 46%, after grew 49%. Like, it literally just hits a new record every year, every quarter. So the subscription model business is booming, and not just FIX, not just their subscription model, but also their advertising revenue. So if you don't pay for their subscription, you see ads, and their advertising revenue is up 45%, 55%. So they've just seen a lot of nice growth. And that's why I'd look into this one. I'm not just going to completely dismiss this as AI is going to eat this company. Like, nah, these are great numbers. What's the forward PE? Let's see though. Are they expensive? Okay, so 40 times forward PE, because again, if we look at the right now PE, it says 21. It's actually way higher. They had a one-time adjustment. If we go to their net income, it says they made 292 million net income. They didn't actually. They only made 35 million, but it was still a record, up 160%. But they're trading at 39 times next year's net income. It might be like, honestly, it might go down a little more, but this might be like where you start to nibble, because again, 38 times next year's net income, that's still kind of expensive, but this is the kind of stock that absolutely deserves a high multiple for this growth, but it's just getting less high of a multiple than it had before. I really liked it. Hey, let's see here. FIX and Murphy's, let's go over MUSA right here. So this is my favorite way to get exposure to oil and gas. And they're, for one simple reason, is because of how they allocate money to the shareholder. most oil and gas stocks are known for their really high dividend yields. Chevron, Exxon has a 3-4% dividend. But here's what's so unique about this company, for example, and this is the main reason I bought this company. It's because, actually going back to here real quick, if we go to this company's dividend, this is an oil and gas stock, their payout ratio is only a 7%. They don't suffocate themselves with a high dividend payout ratio, a single digit payout ratio, and that allows them to raise their dividend very faster than all other stocks. But since they have such a low dividend, what are they doing with all their leftover money? Well, this is the best part. They spend $100 to $200 million of their net income every quarter on share buybacks. That's what I can't believe. And so if we go to their total common shares outstanding, there's total common shares that exist for a company. They've bought back 7.5% of all the shares. After they bought back 5%, after they bought back 8%, after they bought back 10%. No, some of these buybacks were poorly timed, but I mean, MUS, again, they're still susceptible to the price of oil going down, and their numbers are getting hurt by that. Like, look at this. The revenue, the sales, the lifeblood of the company, revenue's down 2.5% after it fell 9% because of how oil is right now. But because they're so shareholder friendly, this is, out of all the oil and gas stocks, I want exposure to oil and gas, but I didn't really want to pick one with the high yield. I decided to pick MUSA because they're so shareholder friendly. And let me show you how much they're dividend. Like, this is crazy. They're making 100 to 200 mil in net income every quarter. We go, and they're spending legit all that on share buybacks, which I love, because if we go to how much their dividend costs, the dividend only costs $10 million a quarter. They can literally pay for their entire year of dividends times 3 just in 1 quarter of earnings. So that's why, in my opinion, MUSA is the one I picked up. And again, you don't probably want to have this as a huge chunk of your portfolio. It might not outperform that tech-heavy S&P 500 in the long run. It's an oil and gas stock, but it's my favorite one. Okay, let's see here. Hey, what up, Nick? Good to see you, homie. What do you think of Visa? Dude, Visa is one of my favorite names out there. Someone said, what's the power of the buybacks? I'll show you the power of the buybacks, because Visa is another buyback monster. Also, Visa is owned by Nancy Pelosi and a bunch of other super investors. A great never sell stock. Forward PE of a 26. That is why I love Visa. It's not expensive. It's not crazy expensive, a 0.72% dividend yield. Look at how they raise the dividend every year. But that's not the dividend is just for fun for them. This is what they're mainly spending all their money on, just like MUSA. If we go to their net income, Visa's easily making over $5 billion of after-tax net income a quarter. That's after they paid $1.5 billion of taxes every quarter. They're left with easily over $5 billion net income. Their dividend only cost $1.15 billion a quarter. So what are they doing with all the leftover money? Share buybacks. At the top here, they're spending $4 or $5 billion on buybacks a quarter. And here's the power of them. If we go to the net income is actually down by 4.2%. But if we go to the EPS, which is net income per share, it's only down 1.13. Again, the EPS growth rate and the net income growth rate should always be the exact same. The only thing that changes the EPS is the share part of the ratio, and the shares went down by 3%. So you own 3% more of the company. That's after they bought back 3% of the company the previous year, after they bought back 3%. So you basically get, here's how the stock works. You get 3% in stock, or you get 3% in share buybacks, 0.8% in dividends, and then probably 4 to 5% stock price appreciation every year. So this is a stock that I think will outperform the S&P 500. I really like Visa. Okay, let's see. So, hey, what up, JT? Let me take a sip of my water here. What are all the stocks you got on my watch list? Well, hey, I have so many different watch lists here. Like, I have my safe never sell watch list, the hidden gems, the zero debt watch list. Every stock in here has no debt. Okay, sorry. Like Reddit, Zoom, Yelp, Powell Industries, Opera, DocuSign, Instacart, they all have no debt, which is kind of cool. So, hey, we'll try and get to DeFi here in a minute here. Trying to spam there. Yeah, we'll try and get to these. I'm thinking of trimming Google. It's my largest position. I'm up a lot. Can you convince me not to? I will absolutely convince you not to trim Google. Just to maybe trim literally less than 5% of your position or something, just to satisfy you. But I also, Google is now basically my second largest holding of all time, and it grew to that way. It's our largest holding in here by far. We got $5,700. My position is worth $5,700, and here's why I'm not selling. It's not the right time to sell Google. This is the thing. I think Google, it's not crazy expensive, and I wouldn't trim out of this one, or certainly wouldn't fully sell out of Google. That would be a mistake, but Google right here, the forward PE, this is why we're not in a bubble. The current PE is a 29, the forward PE is a 28. So they're supposed to grow their net income a bit from next year, but the 28 forward PE for Google is very fair. This is an ETF in one. They literally own YouTube. They own the Android operating system, the Google Play Store. Every time you spend $100 in the Google Play Store, they keep $30 of that. The Google Cloud is huge. That's at a new record. Just took 1% market share away from AWS. They acquired Wiz for $10 billion, puts them in the top 10 largest cybersecurity plays. They own Waymo, quantum chips, TPUs. They're just a beast of a company. If we look at their net income down here, they're making like 25 to 35 billion in net income every quarter. I mean, this is nuts, the net income they're printing. And what is Google doing with 30 billion net income a quarter? Well, they're mostly share buybacks now, or actually investing in AI, but they're spending 15 bill or 10 to 15 bill on share buybacks a quarter. Their dividend only costs 2.5 billion a quarter. That's what's so cool about Google. They could afford to right now to 3-4x their dividend, but they choose not to, which is absolutely the right move. And since they choose not to, they can deploy it on share buybacks. And also, if we go to the cash from investing activities, Google is investing a bunch in AI right now. Same with Meta. That's being questioned about Meta and Amazon. That's why Apple's being rewarded for not spending so much on AI. But yeah, anyway, I love Google. They're literally like OpenAI in one now. They've beaten OpenAI at their own game. The Gemini 3.0 model is now better than ChatGPT. They can integrate it better. Yeah, Gemini too. I forgot to say that. Google's an AI play. It's so cool. Yeah, what up, eyes? Google's not crazy expensive. It looks that way because it's at all-time highs. But I mean, PE at 29 is like that doesn't scream to me like super expensive. I mean, actually, even Microsoft is pretty cheap. I mean, if you're looking for another Mag 7 to never sell, Microsoft's another great one. They've had a rough week. Look at that. 33 PE for Microsoft. I mean, that's fair. Okay. Okay. Ooh, Luffy, Monkey D. Luffy said Palantir. I think Nebius and their automotive cars are better than Waymo. Wait, Nebius? Are you sure? Nebius doesn't do that, I don't think. Are you sure you mean Nebius? Because Nebius, I thought, is that data center company. I don't think they have anything to do with robotaxis, but that'd be interesting if they do, and I'm wrong. But here's Palantir right here. This is a company with a super expensive valuation. I can't pay it personally, but this one definitely deserves a high multiple. They actually traded 209 times next year's net income. So expensive, but this is the kind of stock that deserves a high multiple. If we go to their government revenue, which is 53% of their total business, the growth is insane. Revenue's up 55, after grew 33, after grew 12. Like the growth rate is growing on the government revenue and also on their commercial side. This is the main growth driver. That's up 73. Like, look in the middle. There is no red numbers. It just grows. Crazy growth rate on the business. Printing net income now. Fortress balance sheet. No debt at all. No debt whatsoever. Making interest on their cash. I love all their financials, and their financials totally justify a high multiple, but I don't know about this high of one. I'd love to get into them. That's the kind of stock I'd own and hold forever. I love your vids. I'm new to trading. What stock should I buy? Well, hey, first off, I wouldn't trade. Honestly, I think you'll get better returns, or actually statistically, you will get better returns. The average trader, average hedge fund can outperform the S&P 500. So literally have the backbone of your portfolio in the S&P 500, or you will be disappointed with your results. So keep the backbone of your portfolio in S&P 500, then buy some individual names, like that and love, like Meta, Google, Constellation Energy, McDonald's, Amazon, Coca-Cola, invest in what you know. Ferrari's good. I'm down 5% on Ferrari. I'm looking to buy a little bit more of them. IDCA, yeah, I think dollar cost averaging is pretty fair. Would you buy Google at its price? Honestly, well, me personally, since I already have 19 shares, I'm not looking to add Google as a bigger portion of my portfolio. But if I was someone who owned no Google, I would start. I would make Google. If I wanted Google as 5% of my portfolio, I wouldn't make it 5% today. I make it like 1% or something. But as it falls, then you dollar cost average into Google. If you want to buy a stock and want to get into them, don't spend all your money at once. Slowly buy into them over time. It's a more patient, disciplined approach, and it might save you. What app is this? Yeah, hey, this is actually a brokerage where you buy stocks. Yeah, if you want to buy stocks, this is my favorite platform to buy it on. No fees, no cost, no anything. Completely free. It's in the link tree in my bio, that very first link there. Broker called Moomoo. Or actually, I'm not sure which one you're talking about, actually. I got all these brokerages linked up there. I got Robinhood as well and Webull. All three of them are linked up there. My favorite one is the very first link there. Okay, so then it's the one I'm on right now. Okay, let's see here. What makes you determine if a stock PE is fair? Well, it's so many different things. It depends on the industry, the growth rate, like the moat. There's so many different things. Like Powell Industries probably deserves a 20 PE because it's 60% of the revenue comes from oil and gas. So this always will probably not go back to 25 PE ever. Okay, like software. Actually, software is starting to trade lower PEs. So can we? What is SanDisk? Hey, yeah, if you guys got a stock you may look at, let me know. Hey, what up, Billy? Good to see you, man. Harlow said ISRG. This is actually a cool medical robotics play, and they have some of the best numbers I've ever seen for a stock. Hey, Rowan, thank you so much for that corn there, that corn gift there, or whatever that is. I appreciate that. But here's ISRG. They're expensive, 66 forward PE. But this company deserves a high multiple. Check this out. If we go to their instruments and accessories, they make these what are those called? Like radiation scanners, or like the thing where you can't have any magnets on you, whatever. They make those things, and the revenue's up 20%, after grew 18, after grew 23. And not just that side, but they also service these instruments. And the servicing revenue is also at a new record. I mean, everything here is just headed in the right direction. If we go to their net income, they're printing money. And at this growth rate, what's it going to be the same time next year? They're doing 20% growth, but they're doing 700 mil of after-tax net income a quarter, and they have an insanely good balance sheet, literally no debt at all, completely debt free, and $5 billion of cash. And that cash isn't just sitting there doing nothing. Since they have no debt, they're keeping their cash in these 1 to 3 week treasuries, and they literally earn $95 million of interest on their cash, which just goes to the bottom line. So yeah, that's how the operating profit was 759 and the net income was 709. Really close numbers because again, the operating profit doesn't include the taxes or the interest. So normally this would be way lower than operating profit because you include the taxes, but the interest bumped that up. So anyway, I love them. Okay, let's check out Nebius. Yeah, Nick said they have AV Ride. Let's check it out here. That's actually a NVIDIA stock right here. So let's go to the NVIDIA portfolio. They own CoreWeave, APLD, and Nebius right here. Their main business, I'm pretty sure, is data center hosting. I haven't heard about AV Ride before. But let's see. Is there any news? Nebius secures major contracts with Meta, Microsoft. Oh yeah. Projecting $7 to $9 billion in annualized revenue by 2026. Well, what's their current? Yeah, the growth. This is the best part about Nebius, is how growthy they are. If we go to the revenue, it went from 32 million to 150 million in year over year. That's over 4x increase. And if we go to what the analysts are expecting, it was a record this quarter, 150 mil. They're expecting it in 2 quarters to be 469 mil. I mean, just monster growth. And actually, they're still expected to lose like 100 mil a quarter, but in 2 quarters, they're only supposed to lose 66 million. So it really does look like they're narrowing their losses while growing their top line. That's good news. What's the, no forward PE on this one because they're not supposed to make money for a while, but they're interesting. I probably wouldn't have it as a huge size position, but they're probably like a high beta NVIDIA name. Like if NVIDIA goes up, you notice CoreWeave and all them usually go up a little more. Let's see. Hey, what up, Looney? Hey, what up? Good time. Good to see y'all. Would you say PE correlates more to sector? Well, yeah, or like oil. Actually, what's a cool thing is on this app right here, you can see what the industry averages are. Like if we go to oil right here, any oil stock, XOM, go to Exxon Oil right here, and we scroll to valuation right here, PE. You can see the current valuation of Exxon, it's a 17, but the industry average is a 13.9 PE. So they're trading at more expensive than the industry average, which they should, because they're Exxon. Okay, let's see. Oh wait, what was that SanDisk stock someone said? Yeah, hey Phil, what's that ticker? And we'll try and pull it up here. I'm missing out. I'm missing on so many stocks. Like I wanted to get to CoreWeave and stuff and Meta. I'm 18. Do you have any advice to start where to learn? Well, hey, unfortunately, I would just watch the streams. By the way, watch out for people impersonating me. I sell nothing. I have no course, book, WhatsApp. I'll never follow you, DM you, nothing like that. I really sell nothing. So I guess best way to learn from me is just watch the streams, watch my YouTube channel. If you want to help me out, that's the best way to support me. Just sub to the YouTube. Hey, let's get to SoFi right here. I love SoFi. I saw that one a while back and I didn't get to it. Someone just said it again. So here's SoFi, and I'm so sorry. We're gonna be streaming for another 2 hours actually. So we'll try and get to all these stocks here. But this SoFi stock, I actually do own them here in my Webull portfolio. It's a stock I regret every share I've ever sold of, just like Robinhood. I still kick myself for that one. But yeah, SoFi's a really good growth company that deserves its high multiple. You know, it's expensive. Like even after the dip, it's expensive, but they deserve a high multiple, you know, like 60 times next year's net income. That's super expensive. But check this out right here. This is what justifies that multiple. And hey, Thorvald and KATM, thanks for those roses there. Yeah, if you got a stock you may look at, let me know. But yeah, their financial services grew 76% year over year. After grew, Q3. Yeah, after grew 101%, after grew 141, after grew 195. Like they're literally on a streak of growth. No analyst expected it to be this growth. Yeah, I didn't even expect that. And we can actually see the analyst expectations. You know, that's the orange line here. Every quarter they beat on revenue, they beat on EPS and on EBITDA. So no wonder people are starting to really take SoFi serious. They're printing net income over 100 mil of net income a quarter. And their their lending business is at a record, basically 500 mil. It's never even been close to that before. So yeah, SoFi is a beast. Sorry, I'm a little sick right now. Okay, Webull stock. Heck yeah, dude. So I actually just bought a bit more of them last week. Actually bought like 20 shares last week. This stock is probably it's not cheap. It's honestly more in the slight expensive realm. Based off not even the analyst expectations, based off my expectations, which are way more generous, Webull's trading at like 35 times next year's net income, or even probably the year after. But here's why I am buying ticker symbol BULL in my Robinhood portfolio. So yeah, I'm buying ticker symbol BULL. What is Webull? That is actually this app right here, publicly traded, this brokerage. And I've been using this app, this software for a long time, many years. We haven't done good either. We're only up 8.6% all time. But if we head over here, this is what makes me super bullish about Webull. And I've been using the platform for a long time. They've never previously had this. They just announced this right basically on their IPO day, less than 6 months ago. They added this prediction market stuff. So you can do prediction market stuff and crypto on here now. And that's where brokerages like Robinhood have made a boatload of money. That's why Robinhood stock is up so much, because when they added in the prediction markets and the crypto, they make heck of fees off those, and like high margin fees. Because whenever you go buy and sell a stock on a brokerage, they don't make much, but like a fraction of a penny. But whenever you do the prediction market and crypto, that's where they make a lot of money. And so that's what intrigues me about Webull. Again, the stock isn't cheap though. What app is this data from? Well, hey, it's in the link tree in my bio, that very first link there for them app I'm on right now. All these brokerages, they're all brokerages, you know, where you buy stocks on, they all send you a tax form and ask for all your information. They're all in the link tree in my bio. These are my favorite brokerages. The very first link there, Moomoo, this is my favorite one. It costs nothing, completely free, no commissions, no hidden fees, nothing like that. Literally completely free. Okay. Let's see here. I have invested in Ferrari, but the problem is its internal politics. Oh, they do electric vehicle and vehicle construction in Europe and have a bad situation. Huh? That's interesting. I heard they gave like this 2030 guidance thing where they lowered their EV output expectations, and then the stock tanked on that day. So let's look at XPeng right here. XPENG. This is like another this is a Chinese car company, and they're one of the better. Actually, I wouldn't touch any other. I wouldn't own this one with probably a lot of money, but let's see, their vehicle delivery. Their vehicle delivery is up 76% year over year. Well, let's check it. Or those were the monthly. Wait. That's not just vehicles delivered. This is their monthly vehicles delivered. Oh, this is by month. So just this month, they did 42,000 deliveries. Well, if we just go to their total revenue right here, and we've again, Chinese company, ADR, we're going to convert the currency from Chinese won to USD. And we can see in USD, the revenue grew 100% year over year. So the revenue is 2.8 billion. And this is great news. They only lost 53 million in net income. Like they're really narrowing these losses. They used to lose like too much to trust, you know, a couple $100 million a quarter, but they're only losing 50 mil a quarter. That's significantly better than Lucid, significantly better than Rivian. And BYD is profitable. But yeah, XPeng, I like that growth there. And I like how they're narrowing the losses. Yeah, hey, again, this app I'm on, it's in the link tree in my bio, very first link there, software broker. Do you think Google should trade at a 35 PE like Microsoft does? Not right now. Honestly, it would probably peak at 35. Like I couldn't see Google trading much higher than a 35 PE. Or honestly, I'd be shocked to see Google at a 35 PE. Ooh, CTRE. This is such a cool REIT. If you like REITs, and if you want to invest in senior housing care facilities, this is one of my favorite REITs out there, and they're actually at an all-time high. That kind of just shows how like defensive they are. They're at an all-time high on top of paying you a 3.5% dividend every year. This chart doesn't even include the dividends, so this is actually a good-looking chart. And this is what's crazy. Look at the revenue growth. If we go to the sales, the revenue's up 71, after grew 40, after grew 11. Like the growth rate is insane. And same with the net income. You actually don't look at net income. You actually look at the basically core FFO. But they're one of the most under-leveraged REITs. You look at ADC, Realty Income, AMT, whatever. They're super leveraged. This is one of the most under-leveraged REITs that exist, which is another great thing I love. But they're making 100 mil a quarter. Well, let's actually use the net income. The net income does not include the depreciation and the amortization, which is super important for a REIT. But we'll just look at this number. They made 100 mil this quarter, and the dividend cost, or 3.5% dividend, the dividend only cost 67 million. That's a safe payout ratio. No wonder they're at all-time high. And it's not just them, Welltower as well. Well, it's like the same thing as Welltower, but Welltower has a much lower dividend. What's actually their yield? 1.4% yield on Welltower. Yeah, these are your senior housing care facilities, which are like really popular right now. Let's see here. Joe, do you think Webull stock is suppressed because it's technically a Chinese company? That's the thing. Webull stock right here, it's like I don't know what they did. They've like bended the rules here. They were like originally a Chinese company, but now they're actually headquartered in Florida, the USA. But they're like, it's interesting. This isn't an ADR stock. There's no weird tax forms or anything. It's just like your normal stock, and they're headquartered in the US. But yeah, I don't know there. For Bull stock. And yeah, we were just buying more Bull in our Webull. Yeah, we actually own them in my Roth IRA. Again, I wouldn't have Webull as like a big size position. You wouldn't want to have it as a major size position. I have $400 of it. So let's see here. Walmart and Netflix. Here, let's do Netflix right here. Oh, TLRY. Yeah, this company sadly is under $1 currently. I think dollars can be made. Do you agree? Sadly, I don't care about this industry, but the financials I do care about. And I can honestly see why this company is only worth $1 billion. If we look at the market cap, what the whole company is worth, $1 billion. So you could buy it at that valuation, you could buy the whole company for $1 billion, let's say. So you buy the whole company for $1 billion. Here's the rough news. If we go to the net income just last quarter, I don't know how this is possible, but they lost 1.3 billion in net income just that quarter. The quarter before, 800 mil. And kind of sadly, like even if let's assume that was a one-time adjustment and not look at that. Like even when we remove those 2 quarters, like again, the whole company's worth $1 billion. $85 million of losses is 8.5% of the entire company. So sadly, the truth is just, another bill. Just all for eternity, this company just can't get profitable. And whenever you lose net income, that money has to come from somewhere. So look at the balance sheet, the cash just, so sadly, I would not. This isn't the kind of, it doesn't scream. What's the revenue growth rate? Do they have sales growth? So yeah, the growth isn't even that good, low single digits, 4, -2, -1. And they're in this industry. I'll hopefully I don't get taken off. Okay. So sadly, I wouldn't probably trust that one with a lot of money. Hopefully that was helpful there. I've been there, done that. I own stocks I shouldn't be. You can always understand why a stock is at an all-time low or at an all-time high because of their financials most of the time. Like ChargePoint, the reason this is up, this is one of my biggest losses of all time. We lost over $2,000 on just this stock, and it's always worth it sometimes to take the loss on a stock. And thank goodness I took the loss on this company. But here's another great example of a stock. Not just this one, but a stock that has similar financials like this. These are the kind of companies that just continue to go lower, lower, lower. Like this one will also just, I think, go lower. The whole company is worth 183 million. That's their market cap. They're worth 183 million. When we go to their net income, this is devastating. Negative 60 mil, 50 mil. That's well over 200 mil in net income they lost, which is more than the market cap, and the growth is gone. Sales are down 9% after it fell 27 after it. So it's tough. Ooh, what app do you use to buy stocks? Yeah, hey, what up, Gus? It's actually, this is my favorite brokerage right here. It's in the link tree in my bio, very first link. They're a broker called Moomoo. You can just type it into Google if you want. But if you want to use my affiliate link, it's in the link tree in my bio, very first link there. If you go to deposit $100, we'll both get like some free stocks. But yeah, this is my favorite brokerage to buy stocks on. Completely free, cost nothing, no commissions. By the way, all these brokerages are all in the link tree in my bio, and they're all affiliate links too. So I like Robinhood as well. Robinhood and Moomoo got to be my 2 favorite ones. Okay, Yeah, I like this one the most because it's the most useful and no fees or anything. Like with Robinhood, you got to pay $5 a month for some of the features, but not with this one. There's nothing like that. Okay, I bought 30 shares of Webull. Hey, nice, Mr. Phil. That's a safe amount. You know, healthy, safe amount. You don't want to go crazy yet into Webull stock. But I agree with you. I think Webull's certainly an interesting company and stock right now because of this new prediction market and crypto stuff that'll add money to their bottom line. But hey, shout out to the member Jeff Mack on the YouTube stream. He said, "Can we look at Gap stock?" Yeah, this is like that mall company. They're actually, you don't really want to buy these for the long run. You know, you're not buying this to expecting to outperform the S&P. You buy this for like the cyclical nature of its like heavy swings usually. Like sadly, Gap is the same price that it was in 1998, but I think they have a high dividend. What's the dividend? So not crazy high, but you get a 2.6% dividend. The payout ratio is a 27. If the payout ratio like 2.7 is nearly the same as the dividend, that means I'm going to guess they're trading at right around 10 times PE. Or 11 PE. So let's see here. Revenue, low single digits. You know, we kind of expected this for a mall stock. You know, sales are up 2.9 after it grew 1. After it fell by 6, after it grew by 2. So, you know, let's look at the annual revenue here. So yeah, it's kind of just higher revenue in 2013 than it is today. But if we go to their net income right here, actually look at that. The profits are starting to come back. You know, they used to make 800 mil to $1 billion every year. And for the fiscal year 2025, for the past 4 quarters, they've actually already made 844 mil. So it looks like the net income is back, which is good. But again, I wouldn't really want to own this. Or look at it. Well, here's the bull case. They're making easily 200 mil in net income a quarter. Easily 200 mil a quarter. Let's go see how much the dividend cost. The dividend cost 62 mil a quarter. So, and it looks like they're doing buybacks. They spent like 150 mil on buybacks. I don't know. Not interesting. Yeah, hey, you know what? I'll type it in for you. What up, Phil? SanDisk. Okay, it's SNDK. Let's check it out right here. So this is a $29 billion company that, let's go see what happened, because that's some crazy stock price appreciation. You know, $40 to 200, and basically, wait, that's just a quarter. From August, the stock is up 4x. Oh, wait, hey, watch out for that guy in chat there. This is why I gotta mod more. Now watch out for the people in chat there. By the way, I saw nothing. I have no course, book, WhatsApp, Telegram. I'll never follow you, DM me, nothing like that. So check this out right here. If we look at SanDisk right here in their market cap, the whole company is worth $29 billion. Let's go see what the growth is. So revenue's up 22% year over year, 2.3 bill. And I'm guessing they didn't make net income on that because, maybe that was actually, they actually did make 150 mil in net income or 112 mil. What's the expectations here? So the revenue is going to go from 1.62 to 2.6. That's a good growth rate. Oh, so the EPS expectation is going to be $3 a quarter. Whoa, $3 next quarter and $3 the quarter after. So then and look at the EBITDA too. EBITDA is supposed to literally go from negative 45 million to positive 650 million. So what's the forward PE? So if that's true, I mean, if they can meet these numbers, this stock might actually not even be crazy valued there. You know, the forward PE is a 13. So that's it's pretty fair. Okay. Do you need an ID to be able to start buying? Yeah, you do. For any brokerage, that is. You need an ID. They ask for your information. They send you a tax form at the end of the year. That's with every brokerage. Okay, let's see here. Wait. Yo, what up? S. Lopez says, thoughts on Google. Hey, remind me to look at Google in a little bit. Hey, what up, KNT? How's it going? Let's look at CoreWeave right here. I saw some recommendations for CoreWeave. And hey, what up, Isaac? We'll get to SE by Kronos. Hey, what's the ticker symbol for Kronos? I'm pretty sure Kronos, that the main shareholder of that is Altria. But let's go over here to this portfolio. This is in the NVIDIA portfolio right here. And check this out. Their largest holding is literally CoreWeave. It's 80% of their portfolio, but they actually lowered their guidance on some bad numbers, unfortunately. So check this out right here. If we go to the earnings hub right here, there was some great news. Like their contracted backlog, they have literally a contracted backlog of 55 billion, and it doubled quarter over quarter. So insane backlog, and that was driven by a $14 billion deal with Meta and a $6.5 billion expansion with OpenAI. Those are their two biggest, two biggest causes for the huge backlog growth. And also, but here's the bad news. The operating margins were below expectation at 4%. So bad, but it is impacted by delays in third-party data center deployments and increasing scaling costs. They said that they literally aren't going to be able to fulfill their backlog as fast as they thought because they're not going to be able to get these data centers built in time. So there was a bit of a future delay, but the best part about CoreWeave is just how growthy they are. If you go to the revenue's up from 500 mil to 1.4 billion year over year. The triple digit increase of the sales every single quarter. So they're going triple digits every quarter, and the analyst expectations as well. The revenue is going to go from 1.4 to 2.3 billion. So, I mean, just insane growth here. So that's CoreWeave. Again, they're supposed to lose money. Like analysts are expecting them to, if we go to their EPS right here, still expecting them to lose like 200, 300 million net income a quarter for a while. So that's why I wouldn't have probably CoreWeave as a major size position, but it's kind of like a high beta NVIDIA. Whenever NVIDIA is up like 1%, they usually go up like more than that. Okay. Hey, what up, MV? We are back. Yes, sir. Let's look at SE right here. I think this is like a international play of something. Let's see. Yeah, market. Okay, so look at this. If we go, where does this company get their revenue from? 70% of this company's revenue comes from Southeast Asia, Latin America, and rest of Asia. So this is, yeah, it's like the Southeast Asia Amazon. They're an e-commerce company. If you go to their e-commerce sales, let's see. That's phenomenal growth in the middle here. Sales are up 35, after grew 33, after grew 33. So no, what's the forward PE, or what's this right here? Active users, they have 670 million quarterly active users. Okay. And the forward PE is a 37. So they're trading at 38 times next year's net income. That's probably, this is the kind of company that definitely deserves that kind of multiple. They're just now getting like super net income positive. Like just last year, they were losing a bunch of money. But right now, that's real. They made, 375 million net income. That was after they paid 100 million of taxes. So these triple digit growth rates is insane. The EPS growth rate is insane and is expected to continue to be good. Actually, I kind of like them. All right. Wait, is KNT a stock, or was that just hey? Let me, if you meant KNT as a stock, let me know which one you're talking about. Is it this Canadian company or this Hong Kong company? We'll try and see there. Let's see. Hey, what up? Wait. What do you think of Beyond Meat? Yo, this company is. We saw this coming. This is the kind of stock that's just going to continue to keep on hitting newer and newer all-time lows after it does a lot of this more kind of momentum stuff like this. You don't short this company. What is the short interest on this company? Because there's a ton of it. Short interest is, well, it actually just went down because of all the craze. There was a 70% short interest just in October. Now it's 16%, which is still insane. 16% short interest is nuts. But that's crazy. But here's why Beyond Meat sadly deserves to be at an all-time low. If we go to their net income right here, this is the bad news. They are burning through net income every quarter. And what's the whole company worth? Here's how I like to think about this. Yo, pheromones. No way, dude. You just sent me like hecka gifts on TikTok. No way. Hey, we'll get to your stock after this. If you got a stock, you're like, let me know there. I appreciate that. But yeah, Beyond Meat right here, they're worth 390 million. Kind of think about that. The whole entire company's worth 390 million. You could buy it for 390 million. But here's what you're buying. You're buying a business that just lost 110 million net income. 1/4 of the whole company. Then the previous quarter, 30 mil, 50 mil, 40 mil. Like just for all of eternity, this company, all they've done is just burn net income. And they've lost their growth rate. If we go to the revenue right here, the lifeblood of the company, the sales, the revenue's down 13%. After it grew 7, but that's after it fell 9, after it fell 22. I guess America has really responded no to plant-based meat. And also they're burning through, 100 million net income. They're burning through 50 to 100 million net income a quarter. How are they going to pay off all this debt? They're extremely leveraged, twice as much, well, as actually more than that. Anywho, wouldn't touch Beyond Meat. You normally, if you look at the financials, it totally explains why a stock is at just like all-time highs or lows. Hey, no problem there, Mike. I appreciate you. I hope the absolute best it will do is, wait, what was that stock right there you're talking about? Buy Kronos. Or is this one? So actually, if we go to shareholders right here, yeah, just like I thought, Mo is the largest shareholder. This was Mo's way of getting exposure to this industry. We can't look at it too much more, but are they making at least any money? So no, they're still losing money every quarter, but they've significantly narrowed the losses. Actually, you're not going to believe this. Mo bought the 40% stake. Mo paid for this 40% stake in the company, $1.2 billion for that stake. And the whole entire company is only worth 900 mil today. They bought their stake literally when the stock was at like Anywho, another one, it's not the end of the world on that one, actually much better. So, hey, thanks again. Wait, did Fairmount say a stock? Hey, thanks again for all those gifts. I appreciate that. And Akula, thanks for that gift there. Okay. Roblox prediction. Hey, let's do Roblox. And then, just jumped on. We have not looked at MU yet. Oh, we still got to get to Google. And some other, we're going to get to MU after this. MLI. We'll try and get to all these here. We will. So wait, what was the stock I just wanted to look at? It was Roblox. Okay, actually, you know who owns Roblox? That's a big one in the Cathie Wood portfolio. So if we go to Cathie Wood's portfolio right here, it's actually now not one of her top 4 positions because of how much it's fallen. Wow, it's only 3.2% of her portfolio. Yeah, look at that drop. Sadly, we foresaw this drop on Roblox. They burn a super unsustainable amount of money. And but there's some it's not to be completely dismissed, though, because there are some super impressive numbers if they're not fudged by AI bots. I mean, I don't know how this is possible, but look, their daily active users went from 88 million, literally 88 million daily, to 150. Now, I don't know what caused basically a doubling in the daily active users, but I don't know if it's all organic, but that's insane if that's true. But if we go to revenue right here, it makes sense. The revenue's up 47 after it grew 28, after it grew 37. So the sales are great. The daily active users are great. So why is the stock? It's this net income losses right here. They're burning through a bunch of net income every quarter. They lose over $1 billion a year, basically 250 plus million net income a quarter. And it's not gotten better. It's gotten worse. Yeah. Hey, again, Orel, if you want to get this app I'm on, it's in the link tree in my bio. Very first link there. It's actually a brokerage software, but where you buy stocks on. If you want to get the app link tree in my bio, broker called Moomoo. But yeah, Roblox loses 250 million net income a quarter, and they have a bit of leverage. You know, they have a bit of debt to pay. Can't really pay off debt when you're losing 250 mil a quarter. It actually adds more to your debt every quarter. But if you go to the free cash flow is positive. So the free cash flow positive, 400 mil. But why is the net income negative? It's because of their stock-based comp. They're literally paying their employees hundreds of millions of dollars of stock-based comp, and that is included in GAAP BPS and GAAP net income. So that being said, I'd look into them, but nothing serious, not a big size position because of those net income losses. And they're also being investigated right now for like safety practices for young people. So here's Micron Technology. I would not sell this company. In my opinion, this is the kind of stock that's just going to continue to go higher and higher and higher in the long run. You know, there's a little noise now, but in my opinion, I would not sell or trim this stock if you were holding this one. And if you didn't have a position, I'd maybe look into nibbling on this one because this is a great semi play. Just as growthy as the industry. Let's see. We go to the revenue down here. The revenue's up 46% after it grew 93. So they're on a streak of growth. And out of this, they did 11.3 billion of revenue. Out of this 11.3 billion of revenue, 3.2 billion of that was after-tax net income. You know, after they paid 600 or 500 mil of taxes. I mean, that's crazy. So, and that's real. And the analysts are expecting, look at this, the EPS is going to go from $1.40. It's going to be $3.50 next quarter and $3.70. So if we go to the forward multiple on this company, if we're looking at what are they trading on next year's net income? 13 times next year's net income for a company that's doing this sort of growth. So that's why it's certainly fascinating. Now, one reason they have been suppressed is because if you go back to just a couple years ago, or not even that long ago, 2023, this was a company that was burning through a lot of money, $1-2 billion a quarter, but they finally got their profits and growth back. And that's why this one's interesting. And they have a dividend too. MLI, what up, Greed? So MLI, I've actually not heard of this company before. This is Moeller Industries, and they're at an all-time high. Yo, congrats if you own this one. You know, you got to be up on your position. That's nuts. Let's go see what happened here. So they're in piping systems. You know, it sounds like a commodity that can't really get hurt by AI. Industrial metals. And they're also in climate, so maybe like an HVAC sort of thing. So there's no analyst there is analyst expectations, but it's like little. Yeah, big beat on EPS this quarter and a triple beat on EBITDA. I mean, looks like it was just a phenomenal quarter. The sales were up 8%, so the revenue is up by 8%, but the net income is up by 22%. So what does that mean in English? That means they're expanding net margins. Yeah, that's insane. The year-over-year growth of their net income every quarter is just really good. So they're doing like 200 mil plus in net income a quarter and this phenomenal balance sheet. Look at that balance sheet. 1.3 billion of cash, no debt. So is that making them interest? Yeah, they made 10.8 million of just interest on their cash. So what's the forward PE? Let's see. 16. And well, the right now PE is a 16, but the forward PE is a 16. So honestly, this stock probably deserves to be at an all-time high. I'll actually add them to the watch list. Thanks for that one. They have a dividend too, 0.9% yield. They raise the dividend every year. Pretty cool. Let's see. I'm missing NFE stock. What is that one? New Fortress Energy. Yeah, hey, this one's at an all-time low. RIP if you own this one. This is a penny stock. The whole company is worth 300 mil. The stock is $1.20. So we don't really cover these kind of stocks, but let's go just find out what happened to cause the stock to go to all-time low, because usually it's just explained by the net income. And look at this. This is the total reason the stock is at an all-time low. Again, think about this logically. The whole company is worth 344 million. They lost 300 mil in net income this quarter, 500 mil last quarter, 200 mil last quarter. That's devastating. And the growth is gone. The revenue's down 42%. So no wonder this stock is at an all-time low, and it deserves to be at an all-time low. He also said, check the short interest. Yeah, look at that. 22% short interest. I can see what the shorts are saying. I can understand their side of and see why they're doing that. Yeah, I wouldn't touch that one, sadly, unless it's just some short-term kind of swing trade. Don't put meaningful money in there, I don't think. So Mongal said GEHC, GE Healthcare Technologies. This must have been a spinoff from GE Healthcare. Oh, is this just their ticker symbol? Oh, I didn't know that. Well, let's see if there's any news around this company. They reported earnings not too long ago. Let's go see what they were. So they're in imaging, advanced visualization solutions, pharmaceutical diagnostics. How's that doing? Well, that's up 19% year over year. Let's see. Patient care solutions, that's down 6%. Their main business, imaging, is up 5%. So when we blend all that together, their total revenue is up 5.7. And on that, actually, they're making good net income. What's the margin on that? So 10% net margins. It did fall a little bit year over year, and that was real. It really did fall. So something happened to their margins. Yeah, gross margins fell 7%. Net margins fell 10%. Something happened to their margins, but they're printing net income easily. If you average it out, easily over 500 million of after-tax net income. Yeah, that's after they paid 160 mil of taxes. So that's great. And so they're making 160 mil a quarter. Do they pay a dividend? Yeah, they pay a dividend, and it only cost 16 mil a quarter. So, and they just spent 100 mil on buybacks. So the dividend yield, yeah, super low yield, but literally a 2% payout ratio. So what's the forward PE on this sucker? 16. They probably deserve a 16 PE with the slow growth rate. Did they miss on expectations? No, they beat on revenue. The margins is what they missed on. So I don't know. Certainly interesting. Did you know that C Project by... I don't know what that is, Jesse. I don't know what that is there. That's okay. Hey, what up, Pinky? Good to see you, dude. Oh, it was a spinoff. Okay. Yeah. Hey, Datavault. I don't like that one. I think it's just like a Bitcoin mining company. Just they own a bunch of. There's no like secret sauce here. It's just a company that owns a bunch of GPUs, and I think they just mine Bitcoin with this. So. Yeah, no, I've looked at that. Nothing. They're at all-time lows. MicroStrategy. Okay. I was doing some research into NUTX. Let's check out that one. Hey, Diego, are you still here? Do you want me to look at MPWR? Actually, I kind of want to look at that one too. NUTX. They have 25 million repurchase program. Short interest is growing. Seems like a small. It's in that industry. So check this out. $960 million company. Are they making that wait, here's the industry they're in. Hospital division. Okay, so hospital division. Yeah, the growth is fascinating. I remember looking at this one the other day. So yeah, honestly, I like this one. This is real. They really made, 100 million net income this quarter. And the growth really is that good. So actually, I do like this one, but there are certainly some risks. When we were looking at it the last time, like what was the short interest on this one? Yeah, 15% short interest. I think they were diluting you as well. I don't know, but I mean, $7 of EPS this quarter. Yeah, so look at this. This is what I mean by dilution. This only happens when a company dilutes you so much. Look at last quarter. The net income was 16 million. The net income was positive 16 million. So the net income's 16 mil. but the EPS was negative. Again, that's the net income per share. The EPS was negative that quarter despite making net income, I think because of the dilution. I don't know, but so again, it's a $900 million company, but they're making good money. So, but I don't know. It's an interesting like dilemma there. You got to weigh. INDV, please. Or wait, INDV. Yeah. Hey, sorry. We'll try and get to all these stocks here. Hey, we're going to be streaming for another easily over an hour. So this is a $4 billion company, and they just apparently had some great earnings, a massive gap up. Let's go see what happened here. Let's go look at their earnings there. I wonder if there's any, will the AI kind of, no, they won't. Okay. But let's see here. If we go to the analyst expectations, that's the orange line there. And no wonder the stock gapped up so much. The huge beat on revenue, a big beat on EPS, and the EPS expectations are supposed to double. We'll go check out the forward PE and level about the EBITDA. Yeah, they did triple beat by like literally they beat by more than double on their EBITDA, beat by crazy on the EPS and on their revenue. So it's no wonder this stock gapped up on earnings. So made 42 million net income this quarter. Bit of well, actually that's not too much debt. Anyway, there was certainly some good news there. So what's the forward PE? A 14 forward PE. That's just like that's so good. 4% short interest. So that's why the stock might actually climb higher because the valuation, if the EPS really is right and it's supposed to go from, 33 cents to 60 cents every quarter or, basically 230, they're going to be my generous multiple, $2.50 of EPS a year, $32 stock price. That's almost like a 14 multiple or 13 multiple. Okay. Anyway, let's see. Hey, what up, Danny? KO Paying Mood. How's it going? Can you check out? Yeah, we'll look at CVE. Then we'll get to BBWI. Okay. Oh, and then we'll get to MPWR. Oh, actually, let me go to MPWR right now. MPWR. Then we'll get to that one. So here's Monolithic Power Systems. I have this one on my watch list. I'm heavily watching this one. Oh, yeah. And we got to do Google as well. So what happens is, hey, again, if you want to get this app I'm on, my favorite app to buy stocks on, it's in the link tree in my bio, very first link there. Affiliate link too, full disclosure. So if you go and deposit $100, we'll both get some free stocks. But here's MPWR. They're expensive. They're actually trading at 56 times next year's net income. So it's a bit expensive because their right now net income is artificially inflated. If you go to their net income, it says they made 1.45 billion that quarter. Well, they didn't actually. They only made 163 million, but it was still a massive growth. The sales are up 49 that quarter. So everything here is headed but the market knows that. It's not like the market didn't know that wasn't a one-time adjustment. Like the stock deserves to be doing this well. They're super growthy. The revenue is up 18 after it grew 30. And on that, what's the net income? Yeah, and that was real. They really made 178 million of after-tax net income. Oh, and this freaking fortress balance sheet. Geez, 1.3 billion of cash on hand, making a couple $100 million net income a quarter. Yeah, net margins are growing. So honestly, MPWR is certainly interesting. Still probably too expensive to fully buy. Yeah, so look at this. Do beware, where most of the revenue comes from China. 50% of the revenue comes from China and Taiwan. So do beware of that, but really good growth. CVE stock, CVE. So yeah, that balance sheet was crazy. So here's Cenovus Energy, $33 billion company trading at a fair multiple. 14 PE. They're in U.S. refining. Oh, so it's probably normal for this industry. The oil and gas industry always kind of has this, the industry average is at 13.9. So they're probably fair at this multiple. So U.S. refining, oil sands, Canadian refining. So how are they doing? I bet the revenue will be slightly negative just because of the price of oil. Yeah. So the sales are down 4.5 after they fell 5. That's just how oil is right now. But the net income is still great. You're really buying these oil stocks for, this whole time, this is a Canadian company. We've been looking in Canadian currency. So we'll actually convert this to USD. So they did 930 million of USD after-tax net income this quarter, which is great. But, they probably deserve this 15p oil and gas industry. So what's the yield though? Yeah, 3% yield. Check that out. What there's what's great about oil and gas stocks, you buy them for the defense, you're not going to outperform own an oil stock, but you own these as a small portion of your portfolio for the diversification. Whenever there's war fears and inflation fears, currency fears, oil goes up in those environments and you get paid a good dividend in the meantime. So not too shabby. BBWI. Hey, no way. Shout out to the homie Maddie or Label Brand on the YouTube stream. Dude, no way. With the 25 Ron super chat, dude. Thanks so much, dude. If you got a stock you may look at, let me know their label. I really do appreciate that. Oh, yeah, we got to get to EME too. We'll try and get to all these stocks here. Can we do Meta? Oh yeah, Meta too. I want to get to Meta and all these names. I'm missing out on so many. I'm so sorry. But here's Bath and Body Works. Not really one you want to own in the long run. This stock is the same price that it was in 1998. So, and yikes, the stock tanked. What happened? Let's go see what happened on the earnings report, because it must not have been good for them to fall like 30%. So they missed on revenue, they missed on net income, and they missed on EBITDA. So it was a triple miss quarter. They got a lot of debt to pay, but they're still making net income every quarter. But it looks like it's massively gone. Like, look at these year-over-year declines. So the revenue's down 1%, net income's down 27%. So that means their margins got even lower, 4.8% net margin. So yeah, what's the dividend though? A 5.4% dividend. You're kind of buying it for the dividend and the cyclicality nature of it for maybe a swing trade. Not one you wouldn't buy this over the S&P 500 if you just plan to buy and never sell an asset. But honestly, it might be interesting though, because 5.4% dividend yield, how much does a dividend cost? So they made, actually 60 mil last quarter, 70 mil this quarter. Let's go see how much a dividend cost. Dividend cost 40 million. So they can't afford the dividend, but honestly, why this stock shouldn't really even pay a dividend, or I don't know. Yeah, be careful with him. Yeah, hey, I need some coffee, Label. I've been up since 4 a.m. and I don't plan on sleeping for a long time, because we're going to be doing another live stream later tonight in exactly 7 hours and 30 minutes from now. So at 8 p.m. for me, if you look in the top left, it's 12:30. At 8 p.m., we're going to be doing another live stream right when the market opens. Look for some more stocks. So, Fortinet cybersecurity. If you're looking for, I love this industry. First off, cybersecurity, I feel is like immune to AI. As AI gets better, hackers will utilize it and get better at hacking and all that. So cybersecurity is just always going to be in demand and always needed. And they had some, I just really like them as a company. What's the forward multiple on this one? So they're still expensive, 31 times, honestly, 31 times PE is actually probably cheap for a cybersecurity name out of all the cybersecurity names. But check out their subscription revenue. They're a subscription model company, like 50% of the S&P 500 uses them. If we look at the annual revenue, this is what you want to see for a company with like a 30 PE. It just hits a new record every year, every single quarter. So that's growing great. And they're printing net income. They're easily making, 400 or 500 million of after-tax net income every single quarter. So I think did they miss on expectations? Nope. They beat on revenue, they beat on EPS, and they beat on EBITDA. So what that means is maybe they gave some bad guidance. That was 2 quarters ago was the gap down. Oh, they've reported another time since then. So anywho, I actually really like that company. I would happily buy and hold shares of that one. Oh yeah, good dividends. Is this REITs? Hey, I only own one REIT. We haven't looked at a REIT in a while, but yeah, we're just looking at stocks right now. So why do you have to be upset? Oh, I didn't have to. I just randomly woke up. Okay, Archer, please. So sad thing about this. Oh, I wanted to get to Meta. Okay, we'll get to Meta after this. So here's Archer Aviation. I'll be super quick with this one because I wouldn't buy it. I just don't buy these kind of companies. These are startups, or well, not a complete startup, but they just have no revenue. I don't like the revenue-less companies. If you go to the revenue down here, it says no data. It says no data because they've never sold anything. They've never sold a product or a service. And if you go to their net income, they're losing a couple $100 million net income every quarter. Literally just this quarter, 430 mil. So what happens when you have no revenue and you lose 400 mil? Well, that money has to come from somewhere. But how does the balance sheet look so good on Archer Aviation when they're losing 400 mil this quarter? How'd their assets not go down by that much? Because they're diluting the absolute life out of you. They diluted you by $1 billion last quarter. You wouldn't, I believe this is an absolute stock I would not own, sadly, or maybe it's a short-term momentum trade, but they're so dilutive to you, and it's forcing their balance sheet up, but they've sacrificed the future of the company. They've diluted you 50%. After they diluted you 48%, after they diluted you by 25%. Look at the total common shares. It went from 237 to 650. It's depressing. That's not a stock I'd want to own because they're literally funding their net income losses via stock issuance. So I think that stock's going to probably go even lower, sadly. So let's get to Meta right here. I do own Meta, and this is a company that's actually buying back their own stock. So, MU or NU is, we'll look at that one next too. So here's Meta, such a cheap valuation. The forward PE is a 20 on Meta. And full disclosure, I am a shareholder of Meta. We got 5 shares of them. We're only up 13% on time, so we're not like we didn't crazy buy the dip on Meta. I was super happy to pay the valuation I paid. If we go to their current PE, it's a 26. It's actually a little lower than that because if we go down here to the net income, this quarter it says the net income was only 2.7 billion. Again, the net income and the EPS follow each other, do the exact same thing. So that collapsed the EPS, which made the PE ratio go higher because it's the EPS yearly multiple. But that was a one-time adjustment. If you go to the net income, it says 2.7 billion. It wasn't actually. It was actually a record Q3 quarter of profits, revenue, cash flow, on everything. But one thing investors are questioning around Meta is how much they're spending on AI. If we go down here, they're spending $20 to $25 billion a quarter on their AI spending. When it used to be reasonable, 6-8 billion, but they're literally all their net income, or actually more than their net income, they're spending on investments right now. So they actually, for the first time ever, Meta has a net debt position. They've never had that before in history, but for the first time ever, as of 2-3 weeks ago, with that huge data center Prometheus project, whatever, they have a net debt position for the first time ever. So honestly, I love Meta. I'm a shareholder. It's a great never sell stock. Cheapest Mag 7, I think. Microsoft's another great one. So, okay. In Ustock, this is such a cool company. This is actually a crypto bank out of Brazil, and that's where people actually use crypto for transactional purposes. It's because here in the US, we have a good currency. We don't need to do that. But if we go to this stock right here, 93% of the revenue comes from Brazil, which is actually pretty cool. But that doesn't matter. I judge a company off their revenue, and this is the kind of stock that deserves to do well. The revenue's up 42%. After grew 37, after grew 65. So the top line is growing insanely. There's not just the top line growth, but the bottom line growth. They made 780 million of after-tax net income a quarter. They're easily doing 500 mil plus a net income a quarter, which is 2 bill a year. So the multiple, the 20 PE is for 24 PE is like, I could pay that. So I actually really like this one. Their numbers are phenomenal. So I think they're also applying right now for their U.S. banking charter. Let me see if I can find that. Weekly news. Nope, it's not going to show it down here. But I believe NU is right now applying for the U.S. banking charter. Revenue growth of 41% supported by 42% increase in the credit portfolio. Customer base reached 127 million with Mexico processing 13 million. Okay. That's NU. I like that one. Oh, let's get to Google right here. Gloria said this channel popped up. Do you teach from scratch regarding stocks? No. By the way, I saw nothing. I have no course, book, WhatsApp, Telegram, nothing like that. I'll never follow you, DM you. So, best way to learn from me is just watch the streams. But I do appreciate all the support here. Hey, let's go look at Google right here. This is I do own Google. They're my second largest position. As a shareholder of Google, I am not trimming Google, and I think it would be a mistake to it will be a mistake to fully sell out of Google right now. But it may be. I wouldn't trim Google either. This is the kind of stock that just goes higher and higher, and the valuation isn't nuts. That's the thing about this supposedly AI bubble. Multiples aren't some stocks in particularly, but none of the Mag 7 except Tesla, and maybe Nvidia. But Nvidia's actually no. Nvidia's fairly valued. Like Microsoft 33 PE, Google's a 29, Meta's a 24, Apple's a 33. Okay, so anyway, Google, they're an ETF in one. They own YouTube, Android, Google Play, the Google Cloud, they own Waymo, they're in quantum chips, TPUs, the ETF in one right here, and a bunch of stuff I'm also forgetting too. And if we just go to their net income, they print money. They make 25 to 35 billion in net income a quarter. Oh yeah, and a huge AI play. Google has literally beaten OpenAI at their own game. They have a more successful LLM. And what are they doing with 30 billion net income a quarter? Share buybacks, baby. I mean, they're doing 10 to 15 billion buybacks a quarter. Their dividend, they now pay a dividend. They started this basically a year ago. Their dividend only costs 2.5 billion of net income a quarter, and they're making 35 billion just this quarter. They can pay for their entire year of dividends times 5, but they choose not to. Or they can afford to raise the dividend by so much, they just choose not to. And instead, spend on AI and do things that will be better for the total for the shareholder. Yeah. Oh, what was that right there? Google Gemini 3 AI model outperforms OpenAI's ChatGPT and benchmarks. So yeah. Oh, check. This is really cool. Gemini has reached 650 monthly active Gemini has reached 650 million monthly active users compared to ChatGPT's 800 million weekly active users. I'll screenshot that. That's kind of cool. But yeah, Google, great never sell stock with share buybacks, dividends, investing in AI. The perfect never sell name. And 10 years from now, if you trim today, you will regret trimming, I think. Okay, let's see. I'm so behind here. I'm so sorry. What up, Zero? How long do you think Palantir? How low do you think Palantir will go here? That's interesting. I don't know. Honestly, I have no idea where Webull stock is going. Yo, I love Webull stock, but I wouldn't have it as a huge size position. I'm about to get in the market, placing my first trades. Pray for me. Hey, dude, that's awesome. Your future self will thank you for investing in stocks. Again, I don't know what your strategy is, but with stocks, I really think it's not get rich quick at all. The people that are trying to get rich quick by Tuesday are the ones that are going to mess it up. You just buy. It's literally just buy and hold the S&P 500. Most retail investors and hedge funds cannot beat the S&P 500 yearly returns on average. So, and I can't. You can. Well, you can, but. So you need to have, statistically you can't, so you got to have the backbone of your portfolio or a good chunk of your portfolio just in the S&P and the QQQ, and then you buy some of the individual names you know and love, like Meta, Google, all S&P, these are all S&P 500 names, McDonald's, Google, United Rentals, Coca-Cola, Amphenol, Amazon, Ferrari. You stay away from those micro caps. So you can buy the micro caps that are like Qubits and all those, but not as meaningful size positions. I have a bunch of those really risky stocks that I really shouldn't own, but I like owning them as super small positions like PSIX, Robinhood. Well, actually, no, those are great ones. Super Micro. Yeah. Ugh. So anyway, if I like a stock, I'll keep it as a super small position, but I got to be real. And I know that stock probably won't outperform the S&P, and I don't. Okay. Let's see. What price would you buy more SoFi? That's a good question, because SoFi is really expensive even after its dip. I regret every share I've ever sold a SoFi. Same with Robinhood. But yeah, 68 times next year's net income on SoFi. Probably realistically around this like 20, super low 20. Super low 20 range on SoFi. And I'd be shocked if SoFi ever gets in the teen stock price again. I'd be shocked. I don't think. Can you buy one for $1? Is it a good idea? Yeah. I mean, you can buy fractional shares. Yes, buy the dollar. So yeah, like I buy fraction. Like whenever I go spend $5 at McDonald's, I'll buy $5 of McDonald's stock in a fractional share. Like I don't mind owning fractional shares. I got 17.08 shares of them. Carlisle got 13.10 shares. At the end of the day, the quantity of shares is what's you want to focus on. Ooh. Let's see right here. Hold on. I got to report this guy. I'm copying their username and sending it to TikTok. Yeah, watch out for the people impersonating me. And I have a guy now I can, have you ever seen the chat? Like, first 5 people to DM me get a free. Don't worry, that he's going. Okay. Honest company, to be honest with you, and we can look at Nebius after this too. I don't love the honest company, and I've never found the hype of this one. The whole company's worth 280 million, so they're a very small company. And what's the revenue growth? So yeah, this is the thing. Actually, they've lost their growth. That's unfortunate. The revenue is down 6.7% year over year. The last quarter, it was only 0.4, but they did still make net income. They are making net income the past 3 quarters, which is good news. And I think they have net cash at 50 million. But yeah, that was it. Look at what the analysts expected. Analysts expected them to report 99 mil of revenue. They only did 80 or 92 mil. And yikes, it's supposed to fall to 85. So it looks like they've just lost all growth expectations. Looks like, revenue is supposed to fall. Whoa, 15%. Some even more future declines coming. I don't know. Again, they just sell a commodity. 80% of their sales are diapers and wipes. Or I used to break that down or something. But let me see if I can find that. But yeah, diapers and wipes. They're in skin, personal care. They sell healthy versions of them, but I don't know what that. Anyway, and I wouldn't really own that one. LEN. Ooh, Lennar. This is actually, I watched a YouTube video today. Lennar was partnering. They created a neighborhood all out of 3D printed homes. It's they spent way too much money on it, but it was a cool little project I saw Lennar do. This is a home builder. I love the home builder industry because they always trade at low valuations. They print net income, have really high dividend yields, and do crazy share buybacks. So here's Lennar right here. Check this out. And they're super interest rate sensitive. That's why they're so cyclical and they've done bad. But just like Home Depot and some of the other names. But what I love about them is check out the dividend, a 1.6% dividend yield. Check out, that's after they've rose the dividend so much since 2020, but that 1.6% dividend only has a 14% payout ratio. I kid you not. They have triple the dividend yield of Apple, triple the yield of Apple, and the same payout ratio as Apple. So that's, again, that we're comparing home builders to Apples, but yeah, home building is 93% of their revenue. Interest rate sensitive. So if we go to the revenue, it's actually down 6.4. Revenue's down 6.4, but actually they print net income. It actually is down 50%. Is that real? Actually, that's not good. So that's really not good. So it's still incredible number. So they made 599 mil of after-tax net income. Yeah, that's after they paid 120 mil of taxes. So they kept 600 mil of net income this quarter. And let's see how much the dividend cost. The dividend cost, only 129 mil. How did the cost of the dividend go down from 133 to 129? This is the other best part about the home builders. They do crazy share buybacks. They're spending 500 mil plus of their after-tax net income a quarter on buying back their own stocks. So the net income's down by 49, but the EPS is only down by 46 because they bought back 3% plus of the company on top of the 1.62% dividend yield. I like Lennar. I think, was it Buffett that just sold him? Or I think Buffett sold out of a home builder. Actually, when we were speaking to Apple or Google, Warren Buffett did buy a lot of Google. Someone saying like, what do you think about Warren Buffett selling 40 million shares of Apple? Look at this right here. Like, this is why it's a big nothing burger. He sold 42 million shares of Apple, and it's still 23% of his portfolio. And actually, this is his newest position. Google is now 1.93% of the portfolio. But anywho, decreased or sold out of the stock he sold out of is D.R. Horton. He didn't sell out of Lennar. He still owns Lennar, but he did sell out of D.R. Horton. Oh, he actually increased his position in Lennar. Anywho, your view on buying silver and silver producers. I have never found value. The only precious metal I'd invest in is gold. Like, silver is just so tiny. Like, did you know literally if you combine the whole entire market cap of all the silver in the world, if you had all the silver in the world and you had all the copper in the world too, all that combined, you would still have a smaller market cap than Google. Like, Google's huge, but it's a small market that gold is the most valuable asset. Gold is the whole asset is worth $25 trillion. Nvidia's 4, Microsoft 4. I think honestly is like 2. But anyway, look at how good silver's done though. Like with all the precious metals, like gold has done great recently. Honestly, I like gold, and to get exposure to gold, a gold ETF is IAUM. It's the lowest expense ratio way to get exposure to the commodity of gold. And yeah, look at how good that's done. Okay, let's see here. Nebius, Nebius, Iris Energy. These are all like cloud service providers, kind of like an Oracle. They're like a mini Oracle. Yeah, Oracle too is huge. Actually, if you go to the NVIDIA portfolio right here, CoreWeave, APLDs, these are all practically, they own the same assets. They all just own a bunch of NVIDIA GPUs. That's all Nebius, APLD, and CoreWeave are. A bunch of data centers. Actually, I think Nebius was saying they have like an autonomous driving thing too, which is interesting. But the growth in their moats has been through their strategic acquisition or strategic partnerships. Nebius secures major contract with Meta and Microsoft. So Microsoft is giving Nebius $16 billion because Microsoft didn't want to have the liability of the cloud server hosting on their balance sheet. So they give it to Nebius, and so part of that Microsoft Azure cloud is going to be hosted on Nebius data centers. And check out the revenue growth. It's nuts. Revenue went from 32 mil to 150 mil. And they're still losing money every quarter, and analysts are expecting them to still lose a bunch of net income every quarter. But check out the growth. And this is why they're interesting, because as long as they keep up this top line growth, and they are, like, the revenue is supposed to be 460 million in 2 quarters. Like, this was already a record. The sales were already a record 150 mil this quarter. Up from 32 mil. So it's the sales are going to experience rapid growth from 32 mil to basically 469 mil in 2 quarters. So interesting name there, but still, they're not supposed to make any money for a while and wouldn't have it as a major size position. They're kind of like a high beta NVIDIA. If NVIDIA is doing good, they're probably doing good too, because NVIDIA owns them. NVIDIA owns APLD. They own CoreWeave. NVIDIA doesn't want them to go. That's the whole reason NVIDIA is taking stakes into these companies, because NVIDIA doesn't want them to do bad, and then NVIDIA will do bad. And NVIDIA is taking stakes in them and giving them money, all for them to just buy NVIDIA chips with that money. And that's kind of what was the realization last week of NVIDIA going down. Phenomenal earnings, great earnings. Earnings were not the reason it fell. It was market realization. long Wolf, Google backed them. Hey, CW, actually, Google just sold their entire stake of Wolf last quarter. I think Wolf is either a server hosting company or a Bitcoin mining company. Again, another company that just owns a bunch of GPUs, I believe. Or let's see right here. I am curious. Digital currency mining. Yeah, that's what I'm talking about. Digital currency mining, it did increase. It grew 86% year over year. Oh, look at this though. Secured a $17 billion long-term HPC, which is hybrid cloud customer agreements, including partnerships with Core 42 and FluidStack, supported by Google. So yeah, there's something as Google did something, but Google did just sell all their stake. But this is they could have sold their stake, but they're still backing them and helping them. So yeah, supported by Google, expanding infrastructure with 245 megawatt Bitcoin mining capacity. Anyway, looks like it's a company that owns a bunch of GPUs, I think. Should we do APLD too? I want to do the majority of it in a Roth IRA for S&P 500, then the rest in a solo one. If you research on it, hey, that is exactly the right move, dude. I also have a Roth IRA. My Roth IRA is done terrible because I haven't been. If only I just kept it with the S&P 500, my performance would be much better. We're down 1.83% year to date. Thinking my stock picking strategy could outperform. But yeah, that's why I always recommend keep the backbone of your portfolio in the S&P. Then play around with some of your own favorite stocks. Do your own research on them. And William, what up, dude? Or what's this app? Or hey, what up, Slick? Or I'm not actually sure what app you're talking about. I got all these apps right here. These are all brokerages where you buy stocks. And if you want to get any of these apps, they're all in the link tree in my bio. This one I'm on right now is my very favorite one. Very first link in the link tree in my bio, a broker called Moomoo. Or you can just type it into Google if you want, but those are all affiliate links too if you want to. So let's check out InnoData right here. I have not bought the dip on InnoData just because I'm still up like 60%. Yo, life wonders, dude. Thanks for those gifts. The hearts there. Yo, if you got a stock you want to look at, let me know there. I got you. Yeah, InnoData 40. So the current PE is a 50. The 46 or the forward PE is a 46. It's probably a slight bit expensive right now. So I'm not dollar cost averaging in yet, but actually the future growth, they actually might beat these are good expectations. Revenue is going to hit a new record 72 mil, but they announced this new federal program where they're expecting $25 million from the federal government in a contract. But yeah, this is a data labeling company. They beat on revenue every quarter. They're making EPS every quarter. That's the thing I love about them. They're printing net income. But if you go over here to the EPS, they're beating on EPS every quarter, beating on EBITDA, beating on revenue. That's why I like this one. Fortifying their balance sheet, deleveraging. So actually, I do own InnoData on bias, but again, as much as I love InnoData, I think they're going to do great. I wouldn't have it as a super major size position. Like if you go to a Roth IRA, for me, I got 9 shares and it's worth $450, and I didn't even put in $450. I put in $300. So actually, but that RSI, they've really taken a beating. They might have a little RSI retrace and go back up. What stock do you recommend I buy during the next bear market? Hey, yeah. I get none of this as financial advice. I'm not an expert. I don't sell anything or nothing like that. But I think Uber is a good stock on a pretty decent price. Uber, Meta, I'd put these on a watch list right now, or maybe Uber, Meta. Those two seem pretty fair at their current valuation. I don't have anything fresh off my mind right now. I don't know. A Sprouts Farmers Market, I think. What do you think the top 3 most important things are to look at? Well, there's so much, net income and EPS, and there's just so much to factor in. It can't just be 3 most important things, because there's the industry and there's so much to look at. And if there's a moat, are they have anything proprietary, or is the future growth? Okay. Hey, what up? The homie Jace is here. Oh yeah, I saw a few people say APLD. I'll go ahead and let's do APLD real quick. That's another one owned by NVIDIA. We go back over here to the NVIDIA portfolio. Their largest holding is CoreWeave, and their second largest holding is APLD. And they reported earnings, and their earnings were good, and they gapped up on earnings, but they've kind of just been falling because the whole market is. I think they got a big deal from maybe Microsoft, or I don't know. I know they have a big partnership with CoreWeave as well. So their HPC hosting business contributed 26 mil, 40% of revenue, driven by tenant fit-out services. Data center hosting accounted for 60% of the revenue. So yeah, this is like some data center hosting company. Yeah, so it secured a big lease expansion with CoreWeave, increasing contracted revenue to 11 billion over 15 years. So almost $1 billion a year. So anyway, if we go down here, yeah, 60% of the revenue is data center hosting, HPC. If we go to the analyst expectations specifically, this is a good beat. They beat on revenue by a good chunk. They beat on revenue, and they lost less net income than expected. So that's what's actually interesting about APID. I still probably wouldn't, I wouldn't own them with anything meaningful at their current price. Like CoreWeave, APLD, Nebius, I kind of have like the same opinion on all three of those. Like Iris Energy as well. Iris Energy is the same thing too. So do you think we're going to have a crash or the Santa Claus rally? We always normally get a Santa Claus rally just from how the market and psychology always works. Like there is just no traders and there's no sell orders in the sell book on those days because no one's trading. So I think next week there's only 2 full trading days. So I am curious to see what's going to happen. The next 2 weeks going to be important. You ever poke around with IPOs? Nope. Because of how the lockups work, and almost all IPOs are just rug pulls. Like in the short term, yeah, I don't really touch the IPOs, but I have before. Like I bought the Rivian IPO. And made 100% the same day and sold out of the entire stake. And that I still remember that. That's the last IPO I can remember I bought. And that was, dang, that seems so long. November 2021. I was there the day they IPO'd. But yeah, no. Let's see. Is VOO a buy now? If you have the intention to never sell the S&P 500, it's actually statistics show it's buying it like at all-time highs. It's like trying to wait for a time. Like it's worth nibbling. It's worth buying right now. S&P 500 just returns you 10% a year on average, or 8 to 10% a year. I love how it works, how it's market cap weighted, how the S&P 500 moves, and how it's so tax efficient for you. So yeah, just buy the S&P 500, and that's ticker symbol VOO. There's also a bunch of other ETFs, but this one has a really low expense ratio of the S&P 500, run by Vanguard. Oh yeah, let's get to EME right here. I forgot to get to that one. This is MCore. I actually own their biggest competitor, Comfort Systems. And compared to Comfort Systems, they did not keep up with the growth. Like they gapped up on this. This was the day Comfort Systems reported earnings, and they expected them to do good, but they did not have as good as earnings. Let's actually go look at them because I don't remember what they were. So they beat on revenue just barely. Like Comfort Systems had like a 60% beat. They barely beat on revenue. They barely beat on net income, and they barely beat on EBITDA by like single digit beat. So that might be why EME it gapped down on earnings. What's the valuation though? Yeah, that's 23. Whoa, 23 PE. Let's do our own math on that. So is that adjusted? So they're doing 300 mil in net, 250, 300 mil. And that's, yeah, dude, actually, I'm going to put EME on my watch list just because I really, I already own Comfort Systems, but yo, this stock is a heck of a deal. So look at this. So they're making 300 mil in net income a quarter. Let's go see how much the dividend costs. They're making 300 mil a quarter easily. The dividend cost 11 mil. That is a low payout ratio. And since they have so much leftover money, look at that. They're doing like 200 mil a quarter on buybacks. And they also just got added into the S&P 500. I think Comfort Systems is going to get added into the S&P 500 next. But oopsie, why is the chart way down here? Yeah, that was on this day right here. They got added into the S&P 500. So pretty cool. But yeah, I own their biggest competitor, Comfort Systems, which this one has been a monster. My favorite stock of all time. Yo, shout out Dr. Onefly. Next week will be low volume due to holiday. Yup. Yeah, hey. I'm saying, I was saying earlier, the S&P 500 goes up 8 to 10% a year. Dr. Onefly hit us with the inflation goes up 8 to 10% a year. Yeah, well, not that high, but yeah, I know what you mean. That's why you get, actually, that, if inflation goes up 8 to 10% a year, that should scream to you to not just be super cash heavy, put some money away in like a safe index fund, a safe S&P 500, and let your money work for you. Okay. Let's see here. Can we look at HIMS? Yeah, let's do HIMS right here. I like VOO. I have QQQM. Yeah, QQQM and VOO. I love those. So here's HIMS right here. Their margins are being squeezed right now. There's a lot of future uncertainty. Like their subscribers are doing good. Their hormonal products that kind of their online revenue is doing great? Or let's see that. So revenue increased 50% year over year, fueled by a 50% rise in online revenue and a 21% subscriber growth to 2.5 million subscribers. But their GLP-1 termination, basically they used to sell Ozempic on their website. Now they no longer sell Ozempic on their website. Novo Nordisk ended that partnership. And now they sell a different weight loss prescription on their website, but that margin they make on it, it costs way less for the customer. They're making way less actual profits on that now. And that's what, like the top line is amazing. This is why I love Hims. These are amazing top line growth, but it's the margins that just got squeezed quite hard. We go to the revenue, revenue's up 49, but the net income fell 79. And that's real. Or actually, that's even slightly higher than it should be. The real profit, they only made 11 mil of profits, down 46%. The reason the profits were so high up here is because they were milking when the GLP-1 was in shortage and they could make so much money off that. So yeah, their margins are starting to small a little bit. And that's why I think the multiple is starting to come down. And honestly, Hims, sadly, and I like this one, it might go lower because if we look at the forward PE, Hims trades at 62 times next year's net income. And that is why sadly Hims might go a little lower. I hate to say it, but I don't think the risk reward is too amazing yet. It might be probably might be worth to nibble, but I've owned that company before. I used to own them. I did sell out of them. I loved their numbers back here. So it's just definitely a story to watch because the hormones, subscriber growth, online growth, that's all amazing. Okay. Hassan said TE. What's this one? Let me know which one you're talking about. Or TE Connectivity or T1 Energy. Let me know there, Hassan, because a lot of people ask me about TE Connectivity. So let me know which one you're talking about there, and we'll check that out. Ooh, PayPal? Yeah, let's do. Oh, someone else had said PayPal earlier. It was someone I recognized, but I forgot to say hi to him. To whoever said PayPal a while ago, what's up? Ooh, Jace, hey, remind me to get to all these stocks. I've missed so many stocks here. So yeah, here's PayPal right here. We're going to be live actually I have to go in exactly an hour. So we're going to be live for exactly another hour or like 55 minutes. But here's PayPal right here. Sadly, PayPal stock is the same price that it was back in 2017. So you bought the stock in 2017. It's the same price that it is today and without a dividend. And actually, interestingly, PayPal just started paying a dividend for the first time ever. Their first ever dividend was 2 or 3 trading days ago, and they paid 14 cents in dividends. Let's go do our own payout ratio. They did 14 cents in dividends, and the EPS is $1.30. So that's under a 10% payout ratio. So the dividend yield, actually, I want to see what the annualized yield is because it just started paying one. This will actually be interesting to find out. PayPal has a yield of 0.9. So you get a 1% dividend yield. Basically, you get a 1% dividend yield for a stock that has less than a 10% payout ratio. So investors have been disappointed with the slow growth. Like this is why the PE has always been like in the teens, mid, low single digit revenue growth, like 5, 1, 4, 5 is the revenue growth. But this quarter was a good beat on earnings, but the good news is they're printing net income. They're easily making $1.2 billion net income a quarter. And what is PayPal doing with $1.2 billion net income a quarter? This is what's insane. Since the stock is so low, they're doing insane share buybacks. They're spending $1.5 billion a quarter solely buying back their own shares. And here's what that does. Here's what it does for you as a shareholder. The net income's up by 23. But the net income per share is up by 31. Again, the EPS growth rate and the net income growth rate should always be the exact same thing. Only thing that changes it is the share part of the ratio, and the shares went down by a good chunk. And when the EPS goes up artificially, that makes the PE ratio go down artificially, makes the cost of the dividend go down, gives you more ownership in the company. So it just forces the stock to go up, but it hasn't supported PayPal stock too much. And sadly, they might be, what's the PE, or 12? That's probably a little cheap, but it's might be somewhat fairly valued. They own, there was a big deal. Was it Venmo they own? Yeah, I think they own Venmo. They're doing some big partnership expansion. They own Honey. Hey, William, thanks for all the work you do. Hey, you too. Have a great Thanksgiving. I hope everyone does. You too, William. I appreciate that. Vinny said Netflix. Yeah, let's do Netflix right here. So Netflix, subscription model company. I love them, but I can't pay its premium yet. But again, this is the kind of stock that deserves a high multiple in the 40s. If you go to their PE, they trade at 43 times PE. Again, the PE ratio is just the net income multiple plus any share buybacks or dilution, and they're not doing any share buybacks really. But yeah, so they're trading at 43 times net income. This is cool. We can see monthly active or premium subscribers. They got 301 million. This is their average monthly ARPU, their average revenue per user. They're making $11.69 per month per user, which is insane. If you go to their net income, they're printing money, easily 2 to 3 billion of after-tax net income. So Netflix is super profitable. That's why I love this company, and that's why they have a high multiple. I just like to buy them at a lower multiple than this. You know, so for a lot of people, basically their last subscription they'll cancel will be like Netflix. I think I would rather cancel my Netflix and then YouTube Premium, just because I use YouTube Premium so much. So yeah, that's Netflix. I really like them. Anthony said CMBM. Ooh, we got to get to Grab too. Remind me to get to Grab. I like all these stocks here. Actually, we're not really going to cover this company. If you look in the top right, we don't really cover these kind of stocks. This whole company is worth $60 million, and they're at an all-time low. Let's see what happened in them. So the whole company's worth $60 million. Let's see if we'd pay it. So in net income, they lost 10 million of net income just this quarter, which is, 1/6 of the company. Last quarter, they lost another 10, then 26 mil, then 50 mil, then 30 mil. No wonder this stock basically was at bankruptcy before. Maybe there was some sort of some good news here. Maybe they got a loan or something, but that's honestly the kind of stock that might just go lower and lower. Not one I'd trust anything. I probably wouldn't trust any money with them really. So Grab right here, this is one of my favorite stocks. This is literally international Uber. So they do the exact same thing that Uber does, but in all these other countries, Malaysia, Indonesia, Singapore, Philippines. So I actually like how internationally diversified that they are. They're making net income every quarter. They're finally net income positive every quarter. And the coolest part is who they're backed by. The largest shareholder of this company is literally Uber. Uber owns 13% of all the shares. Toyota Motor owns 5.5% of all the shares. So they're backed by some big people. We know the commodity of ride sharing and delivering stuff is just universally needed. So that's like an international way to get exposure to that commodity. Pretty cool. So, oh yeah, Rich Tech Robotics. There's so many robotics names out there. This is one of the worst robotics names. It's like a momentum play, but there's no fundamentals here, or the actual fundamentals are awful. So if I was looking for a robotic stock to just buy and never sell, this isn't one I'd consider. If we go to the revenue right here, the revenue's down 18% year over year. It's $1 million. I mean, 1 million of revenue a quarter. They have no IP, no patents, losing net income a quarter. So I'm not trying to be too bearish on them, but just for the fact that they're doing $1 million of revenue a quarter, that's actually down. They used to do more than that in 2023. So the revenue is just $1 million a quarter, down 18%, losing net income every quarter. Doesn't really impress me too much. On the other hand, though, if you're looking for a robotic stock to buy on a dip, I like this one. So this is Symbiotic. They're also on a decent dip. You could maybe check out, but they still are net income negative. But this company has over 1,500 registered IP and patents for the robotic systems. They're actually a warehouse robotics company helping out Walmart with their logistics and actually the robotic logistics. And if we go to the largest shareholder of Symbiotic, the second largest shareholder is literally Walmart. They own 13.5% of all the shares. So their interests are aligned. They're super growthy too. We just looked at Rich Tech Robotics. They have $1 million of revenue a quarter. Well, this one has 1,500 patents and they have real revenue. 590 million up. The revenue's up 26%. After it grew 50, after it grew 77. That's insane. So that's why I like Symbiotic more. And I don't own them. Ooh, what do you think about American Express? Yeah, let's check out that one. So actually, that's, I think, owned by Warren Buffett. Let me actually go to the Buffett portfolio and verify this. Oh, American Express. Yeah, Warren Buffett's largest holding is Apple. That's 23% of his portfolio. But did you know 19% of his portfolio, his second largest holding, is American Express? It's been one of his best performers. I mean, best dividend growth stocks. So check this out right here. If we go to the dividend, we'll look at the Robo ETF. That actually, I've never looked at that. I actually want to check that out. Yeah, American Express is a nice dividend name. They raise their dividend every year faster than inflation. So you get a 0.66% dividend yield. See, is there any news down here? Credit metrics show mixed performance with rising write-offs. Delinquencies and 2.2% write-off rates. Small business recorded 1.6%, 2.6. Okay. This is the best part about American Express. Oh, fair multiple. Dude, 23 PE on American Express. That's why this stock could potentially just keep on going higher. Revenue's up double digits, but look at this net income. They're easily, and that's, oh, it doesn't show the operating profit because it's a bank, but they're easily making $2 billion to $3 billion of net income every quarter. That's insane. So they're doing $2 to $3 billion net income a quarter. The dividend only cost $580 million. How'd the cost go down from 593 to 580? It's because they legit spend $1 to $2 billion a quarter solely buying back their own shares. American Express is such a shareholder-friendly company. I love them. They're gonna, I think, honestly, just continue to climb higher. The net income's up 15, but the EPS is up by 18.6 because the share part of the ratio went down. So that makes up for the somewhat lower yield. Only 0.66% yield, but 3% buybacks and then plus 3% more in stock price appreciation. This crushes the S&P 500 so far. So let's look at Robo right here. ROBO. This is the it's actually, there's like a Robo thing right here. And then there's ROBO, Global X Robotics ETF. And it actually says it's an Australian ETF. That's interesting. Let's go see what it owns though, because that's what matters. We go to it's a holding. So, this dude, they know what they're doing. They got ISRG as the top holding. Then Teradyne, they're a big robotics company. Their robotics growth has not been good, but they're a huge robotics play, TER. And then there's Symbiotic down here. I'm actually shocked if I was the owner of this ETF, just how momentum-y and how a lot of trash, probably a lot of the robotics names are. I would have its largest holding as Amazon. I'm actually shocked that Amazon isn't in its top holdings. But interesting ETF there. Probably safer than buying one individually. Someone said Grab is not profitable. Grab is profitable. We were just looking at Grab. Grab was making $20 million net income a quarter, right? For every quarter for the past year, Grab made 15, 20 mil of positive net income. So here's UPS right here. This is a bit of a dividend trap. You buy this to maximize your dividend income. And to be honest, if you're 10 years away from retirement, if you're really far away from retirement, this is just not the kind of stock you'd want to own. Then UPS is the same price that it was in 2013. But if we go to the dividend, this is the main reason you're buying them. You're buying them because they have a 7% dividend or 6.9% dividend. It's actually not sustainable, sadly. I'll just show you the numbers for yourself. This is what I love doing. We go to the net income the past 3 quarters, look, it was 1.3 billion this quarter, then 1.28, then 1.19. So let's look at the most recent quarter. They made 1.31 billion of net income this quarter. And here's the sad news. They couldn't afford the dividend. The dividend cost $1.35 billion. They could not afford the cost of the dividend for the past 3 quarters, which is unfortunate. So that honestly, this company might need a healthy dividend cut. On top of them not being able to afford the dividend, the growth is negative now for the past 3 quarters. Sales are down 3.73. Their average daily parcel volume is falling. So to be honest with you, not this really blowing me. We're here they're making $1 billion of net income a quarter, but no, they're not, because it all gets eaten to the dividend, over 100% payout ratio. Unfortunately, we really just want to see the growth come back to them. Not one I'd sadly trust. Plug Power. Hey, Mendo, we've looked at CoreWeave a few times today. We'll look at CoreWeave after this. I got you. CoreWeave is next. Or actually, we'll look at which one should we look at? Plug Power, Open Door. Oh, these are all not so good names. So yeah, Plug Power. This is just a short interest on this company. I'm curious. So yeah, 27% of all the shares are being shorted. Why are 27% of all the shares of this company being shorted? Because the fundamentals aren't good. If you look at the market cap right here, the whole company is worth $2.7 billion. Remember that. The whole company is worth $2.7 billion. Here's the bad news. They lost $370 million net income. They've lost over 10% of the entire market cap just in net income just this quarter. Not even including the other awful quarters. After losing $228 million, after losing $200 million, after losing $1.3 billion. So sadly, just for all of eternity, not even just this year, just for all of eternity, this company just burns through net income in a super unsustainable amount, where this company legit has sadly high bankruptcy risk. And look at that big miss on EBITDA. Earnings before interest was expected to be negative 135. Well, they did negative 350. Look at that big EPS miss. So to be honest with you, another one that there's There's a lot of stocks that I own that have really high short interest, like Powell Industries. I don't mind a short high interest, but that one actually, whoa, look at that. The short interest has plummeted. It went from 16 to 11, or not plummeted too much, but I'm not always scared of a high short interest. It doesn't always scare me, but that one it does, because the numbers aren't too good there. Open Door, we'll look at this one next, because this is just an interest rate sensitive play. Basically, there was this activist super investor that said this is a $40 stock, and then ever since down here, and then ever since then the stock is just momentum higher. This is a pure like interest rate sensitive play. What does Open Door do? They just flip houses. I've been to a few of them. Quite frankly, they're not good at it. But if we just go to the revenue back in 2022, when rates were zero, they were printing money. Look at these quadruple and triple digit growth rates in the middle here. The sales were booming, 4 or 5 bill of revenue a quarter. But then look what happened as rates hiked up so quickly. Remember, in 2023, rates hiked up so quickly from like 0% to 5.25% instantly. Look what that did to the revenue. It went from 4 to 5 bill a quarter to nothing, 900 million. So this is a super interest rate sensitive stock. And to be honest with you, the expectations aren't good. The revenue is supposed to fall to 500 mil next quarter. They're losing a lot of net income every quarter. So this is not another one that I kind of trust with money to just buy and never sell. Is it a fun swing trade because of the volatility? Sure, it might be. 17% short volume. Yeah. Or well, actually, what's the short interest on this one? Yeah, look at how it's rocketed up. 22% short interest. Again, Open Door loses a bunch of money. Growth is gone, but a swing trade for maybe a interest rate play. But even then, I wouldn't own them. Actually, we can see down here the interest rate cut probabilities down here. There's actually on the December 10th meeting, which is not that far away, and this used to be way different. There's now a 69% chance of a 25 basis point rate cut. And January 28th meeting, 56% chance of another 25 basis point cut. So just in the next 6 months, the rates are going to legit be couple 1% plus lower probably. Or actually, no, that was 25 cuts. Or anyway, let's get to CoreWeave right here. So CoreWeave, we'll be quick about this one. They're the number one holding in that's the Cathy Wood. If we go to the NVIDIA portfolio right here, their largest holding is actually CoreWeave. And they had some good news and bad news in the most recent quarter because they had some major big deals from like Meta and OpenAI. Yeah. Check this out at the top here. Revenue growth was fueled by large contracts, including a $14 billion deal with Meta and a $6.5 billion expansion to the previous deal with OpenAI. Their contracted backlog doubled quarter over quarter to $55 billion. So they have $55 billion in backlog of orders that they basically need to fulfill. But here's the bad news. CoreWeave said they lowered their guidance because they said delays in third-party data center deployments and increasing scaling cost. They're not going to be able to they don't have the workers to make the data centers and run them. So right now, they had to lower their guidance a bit. But what I love about CoreWeave, wouldn't have it as a big size position. It's kind of like a high beta NVIDIA, but the growth is insane. The revenue went from 580 to 1.4 billion. Insane, triple digit growth every single quarter down here. And we can see the growth is expected to be 2.3 billion in 2 quarters, basically supposed to double again. So just insane growth. But yeah, they are still expected to lose a couple $100 million of net income for the next couple quarters, like $300 million net income for the next year. So top line growth is there, kind of like an NVIDIA adjacent play. I don't love them. I don't know though, because I love that top line growth, but I don't love those net income losses, and they don't really have a moat because they just own data centers and GPUs. That's pretty much it. What software are you using? Yeah, hey, if you want to get the software I'm on, it's in the link tree in my bio. That very first link there, it's actually a brokerage where you buy stocks on my favorite one. Yeah, broker called Moomoo. Link tree in my bio there, first link. It's actually an affiliate link too. So, Chipotle stock. Let's check that one out. So Chipotle, this is one of the restaurant stocks. And the restaurant stocks have been tanking. And, it's not just Chipotle. You look at any of them. If you look at Wendy's stock, this is sad. RIP Wendy's. Looks like Wendy's is basically at an all-time low today. Or what's the other one? Jack in the Box. Yeah, look at Jack in the Box. This is also unfortunate. Pretty much all-time low. Our Jack in the Box is the same price that it was back in 2005. Krispy Kreme, which is DNUT ticker symbol, pretty much all-time low on Krispy Kreme. So if you're looking to buy a dip on a restaurant stock, in my opinion, Chipotle is one of the ones to look at to buy the dip on because they're one of the more quality names that print money. We go to the Chipotle's net income down here. This is insane. Like, we'll get to their margins and why their stock is tanking in a second here, but they're still making 300 to 400 million net income a quarter. Like, this is great net income. But they're finally getting back to reality, because if we go to their valuation right now, their PE ratio, they're trading at 28 times PE. The industry average is 28. So they're trading right at the industry average. But that, their PE before they reported earnings, like, they were always so expensive, like super expensive for Chipotle. And if we go to the revenue down here, it's okay to have a high multiple as long as you beat expectations. But for the past 3 quarters, they've missed on revenue every quarter. For the past 3 quarters. And so if we go to the revenue did grow. So the sales are up 7.5%. So the revenue is up 7.5, but the net income is down by 1.4 because of their margins are being contracted just from tariffs, inflation, input costs. Like, they have to pay their employees more after their input costs went up. And it's just all the restaurants are struggling right now. Plus, I guess the GLP-1 stuff might be hurting them. Who knows? So revenue growth. So the revenue growth was driven by 84 new restaurant openings. So margins contracted, with restaurant level operating margin down 1% and gross profit declined 4%, impacted by wage inflation and higher beef and chicken costs. So yeah, like I was saying, the labor costs are the same, if not going up, and their commodities of like chicken and beef are going up. Someone said, "I'm hungry for Chipotle." Yo, me too. Okay. Actually, I haven't been to Chipotle. Basically never. Have, well, like 1 or 2 times in my life. But I really like Chipotle as a stock. Okay. Hey, what up? Forky says, what about Iron? Oh, hey, Iris Energy. Yeah, this is another one that basically another high beta NVIDIA name. Just yeah, so but check this out. Iris Energy secured a $10 billion Microsoft GPU cloud deal. Insane. So they reported Q3 results. Oh, wait. Whoa. Hold on. 230 million of their revenue was Bitcoin mining. Wait. Let me reread that. Q1 2026 revenue totaled 240 million, including 232 million from Bitcoin mining. So wait a minute. Is this mainly just a Bitcoin mining company? Again, this is what we're seeing. All the Bitcoin mining companies are transitioning themselves from just mining a bunch of Bitcoin to data or to server hosting, cloud server hosting. So look at that revenue growth. That's insane. Sales went from 52 mil to 240 mil. But yeah, they got a crazy new deal, contract with Microsoft. Maybe they'll make more money with their chips. Instead of mining Bitcoin, they use it for the cloud server hosting, because Microsoft doesn't want that liability. They give it to Iris Energy. Kind of smart. But anyway, I don't know much. Again, no moat here really. I think it's literally just a company, just like all these other ones, that just own a bunch of GPUs in data centers, and then they get big deals. And those companies are really benefiting right now because there's so much cloud demand. You can just see from Oracle, AWS, Google Cloud, they're all booming. The demand for cloud is insane. And part of the Azure cloud's now going to Iris Energy and Nebius. So, okay. Ooh, Iron Mountain. Let's check this one out. Someone said, what happened to Iron Mountain? You're not going to believe this. A short report came out. Gotham City Research take short position in Iron Mountain. They said, I was reading it, they said the shares of Iron Mountain are worth no more than $40 a share. That's what they said. And I can't believe it. And there was a Wells Fargo analyst. I want to see if I can find that. He came out of his way, called that guy a bunch of, oh, it's right here. Oh, wait. No. Yeah, but look right here. Iron Mountain shares are worth no more than $23 to $41 a share, says Gotham. But there was this Wells Fargo analyst that came out, or maybe it's right here. Wells Fargo, the day after he comes out, he maintains overweight rating on Iron Mountain with a $125 stock price. It's 85 today. He maintained it $125 stock price. He's dismissing Gotham City Research short report as it's lacking new insight. The firm believes the report is a temporary distraction that involves understanding the company's mature North America physical storage business. Wells Fargo expects Iron Mountain to continue delivering 10% growth, and I think that as well. So with that being said, I haven't There's really not an expert. I don't know much about them, but I am not really going to add more to my position. The funny thing is, the day this short report came out right here, I bought $500 of the stock the day before. So, okay, Iron Mountain, yeah, they're a data center business, and they they shred they shred paper for businesses that have to. Like one of their main customers are the IRS, hospital. This is for their global informations record business, where they send armored trucks to your businesses to throw away and dispose of papers for you and certain stuff like that. But that's just one portion of their business. They also have their data center business, which is so growthy. Look at these growth rates in the middle here. Revenue's up 33, after grew 20, after grew 27. Their corporate and other is up 46% year over year. Looks like to a new record. And also the best part about this stock is the dividends you get. A 3.6% dividend. I've done so much research on Iron Mountain. Out of all the S&P 500 companies, 95% of the S&P 500 are customers, and 1,000, or out of the Fortune 1,000, 95% of those people are also customers of Iron Mountain, including the IRS and so many businesses. So Iron Mountain's the number one trusted like paper disposal business, but they're also another thing about this dividend is what I love about this REIT specifically, they have a rule where they only keep their dividend payout ratio in the mid 60% for the AFFO. So yeah, anyway, that's a REIT and a real estate investment trust, and so they pay non-qualified dividends. Can you show us your recent potential stock? Well, I'm not sure what that means, but some stocks I think are pretty good deals right now. I think Meta's a good deal. I think Uber is a really good deal right here. Uber stock. Ferrari's starting to get attractive. You know, in this environment with how the market is right now, you can't fully buy the dip. Like, you got to have some cash left over. Like, if you want Ferrari as 5% of your portfolio, you don't make it 5% of your portfolio. And I want Ferrari to be a bigger position for me, but just with how the market is, I have to be really slow with how I allocate stuff right now. And also, I guess there's a little technical bearish flag there, but that doesn't matter. All right, let's see. Aren't literally Iron Mountain with some of their infra? Hey, what up? I'm not sure what you mean there. It looks like there's a bit of okay. WeRide or Lulu? You know, WeRide, this is your you know what? NVIDIA actually owns them. You know what? Let's pull that up. If we go to the NVIDIA portfolio, this is a stock. I don't know why NVIDIA bought them. I think it's because they're buying a bunch of their chips to train their cars off. But, or even, you know, Lucid in their autonomy driving thing, or they actually use NVIDIA's software and GPUs. But look at WeRide right here. This is a Chinese autonomous car robotaxi. Yeah, that's the word I was looking for. Like robotaxi, Waymo competitor, driverless car. I'll pull up their website if there's images here. No, it looks like it's a Chinese. But yeah, it's just like Waymo. Yeah, robotaxi, WeRide. They kind of are copying Zook's model with these cool cars. It's like a whole experience. That looks cool. But anyway, let's go check out their numbers. So again, Chinese company. I wouldn't own them, but I'd rather own Google and their Waymo. I'd rather own Google and Amazon, and I do own both of those because they're so far ahead of this company. But the revenue this quarter was 17 mil. That's up 62%. That's good. But 17 mil of revenue. They're losing a lot of money. 60 mil, 50 mil, 80 mil, 150. I don't know what what's the net margin going to be? I don't know. I'd be careful with that one. Wouldn't have it as a big size position. But interesting. Is Monday market, I hope so, UESR. Let's hope the market rallies up next week. Usually on these, we only have 2 full trading days next week because all the holidays and stuff. There's probably just going to be no trading, and so the market will probably, every single time that every Thanksgiving, the market is usually always green the whole week. So I could be wrong, but most likely the market's going to be really green next week. But but it's all just temporary. Then the next week, what app is this? Yeah, hey, what up? If you want to get this app I'm on, it's in the link tree in my bio. That very first link there, it's actually a brokerage where you buy stocks on. It's an affiliate link, full disclosure. So if you go and deposit $100, we'll both get like some free stocks. We're seeing some people say DVLT. I think this is just another one of the Bitcoin mining companies, or actually, I don't know yet. Let me go look right here. Acoustic Science Division, Data Center Science. Well, what is this? Let me just go look at their website. What is this company? Data. Okay. I mean, websites, is that the same image they use twice? Okay. Website's a little not great, but who we are. Like, okay, let's go. They got 60 employees. Let's see what their numbers are. That's what matters. The numbers are what matters, and they did 2 million in revenue. Hey, that is a good growth rate from the previous year. 2.9 mil of revenue. We just want to, again, you wouldn't have this as a big size position, but you want to see them continue the revenue growth. You know, they lost 30 mil this quarter, 40 mil last quarter. So here's the thing. Here's another tough part. The whole company is worth 730 million. So kind of remember that the whole company is worth 730 million, and they lost 30 mil this quarter, 40 mil last quarter, 10 million. So they've lost well over 10% of the entire market cap just in net income in the past year. So that might be why the stock is where it is today. But as long as they keep up that growth, I don't know. Key results on one page. What were the key results? Yeah, the numbers are it's just such a small company. It's such a very small company. And look at that. It looks like they missed on expectations. It says, like, I think the analysts were expecting 6 million. Yeah, the analysts were expecting 6 million. They only did 2.9 million. And they missed on their EPS, and they missed on their EBITDA. So it was like a triple miss quarter. But the stock, is up. They had a whoa, wait. Up 46% on Friday. Was there some like specific news there that I'm just probably totally missing? I just now noticed they were up 46%. I don't know. Anyway, hey, again, if you want to get this app I'm on right now, it's in the link tree in my bio, that very first link there. It's actually a broker software where you buy stocks on. I want to learn to understand the financials of companies. Any suggestions? Yeah, hey, again, by the way, I literally sell nothing. I have no course, book. I don't teach or anything, nothing like that. I sell nothing. I'll never follow you, DM you, but the best way to learn, I actually have a YouTube video. I make a bunch of YouTube videos for free, and I stream every day for free. I have a YouTube video called How I Analyze a Stock. I guess you can watch that and see how I analyze a stock. But yeah, I guess the best way to learn from me is just watch the stream. I don't have any like behind a paywall course or book or nothing. Literally, I sell nothing. Okay, Rocket Lab. Let's do this one. Actually, this is one of my more favorite space stocks because they have real growth and numbers behind them. They actually just finished their Geost acquisition. Let's see. Rocket Lab executes defense mission, Wallop Island for U.S. military. Rocket Lab prepares Follow My Speed mission. I think that's their Mars. They're launching a thing to Mars or something. Okay, so let's look at their earnings right here. Rocket Lab reported Q3 results of 155 million, Neutron launch delays. So the company maintains a record backlog of 49 launches with 17 new dedicated launches signed this quarter. Pretty cool. So they have a big backlog. I think they have like a $500 million backlog of orders. But yeah, check this out. If you go to their space systems business right here, this is what you want to see. This is great growth. Sales are up 36, after grew 81, after grew 16. So they're on a nice streak of growth. And not just their space systems revenue, but also the launch services. It's also at a record 40 mil, up 95% year over year. So both businesses are booming, beat on expectations as well. But one thing I don't like about them is the fact that they're burning through a 50 to 60 mil of net income a quarter. But honestly, it's okay if they lose that money. And it trends better, and they keep up with this top line growth rate because that's great. The sales are up 47 after grew 54. Like the growth in Rocket Lab is impressive, but it's still expensive just because they're not they're not making any money and not expected to anytime soon. Yeah, hey, Oklo, that is just like one of the most speculative stocks in the whole market right now. I won't go too bearish. I have a whole story about this one, but yeah, not one I trust. This is a SMR play, small modular reactors. There's no SMRs in the U.S. or there's only 3 working SMRs in the world, and none of them are in the U.S. And the first U.S. SMR to come online is maybe going to come in 2030. So this is complete speculation, but that doesn't matter because it's still done great. Well, not great recently, but it follows the momentum of the whole nuclear industry. So you'd buy this stock, not for the financials, not for the fundamentals, for all its volatility that it has. To swing trade or something like that. But if you're looking for the number one best nuclear stock of all time, it would be CEG, Constellation Energy. Number one nuclear play by far. They literally own 30% of all the U.S.'s nuclear reactors. Number one U.S. geothermal play. Top 10 nat gas plays. This is the one you want. They're restarting the 3 Mile Island nuclear reactor solely to power one Microsoft data center, and Microsoft's paying them a crazy premium. They're finalizing their Calpine acquisition, which is going to be $2 accretive to the yearly EPS, which is 50 cents a quarter, and that's more. That is more than the yearly dividend. Like there's so much good news about CEG I like. So if you like Oklo, you're gonna love CEG if you like financials and like that industry. And another one that's kind of related to this industry is LEU. So the nuclear reactors are powered by uranium, and this is one of my more favorite uranium plays. That's still, they trade at 63 times next year's net income. So again, really expensive valuation, but out of all the uranium plays out there, this is probably in the third best one, or probably the second best one, maybe. First best one would be Cameco. But yeah, 68% of the revenue is their uranium revenue. And check this out. If we go to the net income, no other uranium stock looks like this. They have such consistent net income. Like, that's what's so impressive about LEU, that the net income is just consistent. Because all the other, besides Cameco, like all the other uranium names just have awful looking like net income. So yeah, LEU, that's why I think this one has been, that's a great looking stock chart. But yeah, I like LEU. And if you're just looking for the whole ETF, if you're like, I don't know what uranium play to buy, you could just buy a ticker symbol URA. Yeah, its largest holding is Cameco. Oklo's in there, even though that's like the reactor play. What is this? This used to not be in there. It's not even available on here. It only says I could paper trade it. But Sprott's physical uranium. Thought it said testing, but it says trust. Okay, so some sort of uranium play there. But then there's UEC, which they bought a uranium mine off Rio Tinto. Then there's LEU. Okay, let's get out of here. Do you invest monthly? Yeah, I do invest monthly, but I try to lump sum invest whenever there's like a real dip I see. Like, I always invest like a certain amount every month, but sometimes it's less if I like, it's always so different. But yeah, every month I'm investing more and more money. But I do, like right now, I'm saving up a bit more cash than I normally would. But I did just spend a lot of my cash last week. But like in right now's environment is one where it makes sense to be a slight bit more cash than normal. GLXY, what is that one? GLXY, Galaxy Digital. So let's go see what this company does. They're a $9 billion company, engages in digital assets and data center infrastructure. Is this another Bitcoin mining company? Or the digital asset segment offers institutional access to trading, advisory, asset management, staking, and self-custody of crypto, basically. Okay. Let's go look at their numbers, though, because that's what matters here. Digital assets, so that might be their crypto business, which this isn't a Bitcoin mining company. It looks like they're providing like a platform or something like that for people to buy Bitcoin. I don't know. If this is real, I don't know. It looks like this is real. They really did make 500 million of net income this quarter, and that was real. What are the analyst expectations? They really did. That was a real dollar of EPS, but they're expected to make, the EPS is supposed to go to just 8 cents in the negative again. So maybe this is some kind of IPO thing. I really don't know. They're interesting. They're certainly interesting, that I don't know. Because the numbers are just weird. Like, they IPO not that long ago, 28 billion of revenue just this quarter. I don't know. Might be real. Okay. They have data centers, Helios. Oh, hey, thanks for that, G Sniper. GE Veranova. Yeah, this is another good kind of like, way to benefit from the electricity demand right now, because their participation in the PJM auctions and all that, where they have risen the prices. That's what helping out GEV, VST, CEG. The fact that they're all non-regulated utilities and they don't need the government, they don't need the government's approval to raise prices. They just raise prices. So if we go to GEV, let's go look at their numbers right here. Revenue is up 11% after grew 8%, but the sales growth is double digits, like low double digits. But look at the net income. They're making, there was a one-time adjustment, but they're making 400 to 500 million of net income every quarter. Let's see, was that after? Okay. Yeah, 300 to 400 million net income a quarter. It's really low yield, a 0.13% dividend, but only a 4% payout ratio. Let's see what the AI results also. Power segment grew 14% organically, supported by increase in gas power equipment backlog from 55 to 62. Electrification segment revenue surged 35% year over year, with orders doubling organically. Wow. Reflecting robust demand. Wind segment reduced EBITDA losses by 250 million. That's great. So anyway, looks like things are all headed in the right direction there. Forward PE is probably really expensive. 50 times next year's net income, expensive. CEG is way cheaper, but interesting. ENR, hey, what up, Aaron? Let's do ENR stock. So Energizer, is this like Energizer battery? They're a $1.25 billion company. Let's go see if that's true. Yep. And Energizer Holdings. Let's see their website right here. So they own Energizer, Payovac, Inu Finish. All right, I think these Refresh. I don't know. Okay, let's go look at what the actual numbers are. Seems like a discretionary play. So yeah, battery. Well, actually, no. It's kind of like everyone needs batteries, but I don't know if like rechargeable batteries are getting more popular. Does ENR have that, or actually batteries aren't getting more popular? Like with little toys and stuff. But if we go to the revenue, yeah, this revenue growth isn't good. Low single digits, 3.3. Last quarter was 3.4, 0.06, 2, 0. So negative. So a bit choppy on the or slow growth on the revenue, but they're still making phenomenal net income. Yeah, it looks like Q3 was really good for them. They're easily doing like 30 to 50 million net income a quarter. Ooh, but they have some, they're a bit leveraged. They have some debt to pay, liabilities to pay. Do they pay a dividend though? They do. The dividend, that's weird. They pay 20 million in dividends a quarter. And they made 34 million net income. So they can't afford the dividend. Just 6.5% yield. I don't know. It's just, I don't know about this one. Like it seems like it's just low quality. But it's interesting though, like really, because the dividend seems safe. 5 times PE, that might be fair. Like that might be maybe even cheaper. It deserves a low multiple like that, but I don't know. I've never seen that stock. I didn't even know they were public. Actually, let me put them on the watch list just to keep up with them. Yeah, 6% dividend might be safe, but the stock hasn't done too well. Is market open? No, market does not open until 8 p.m. tonight, or that's not even the market open. That's the overnight market when it opens. But yeah, market opens at 9:30 a.m. By the way, we're going to be streaming in exactly 6.5 hours from now when the market is open. So if you guys wanted to follow button, we'll be streaming for them. Do Berkshire Hathaway. Hey, yo, Scott, we'll look at EMR after this. Yes, sir. BRK. So this is Warren Buffett's company, Berkshire Hathaway. They own stakes in a bunch of different companies and stocks like Apple, American Express, Coca-Cola. But then they also wholly own some companies. Like if you heard of Geico before, they literally own Geico. That's that big insurance business. They're in manufacturing, McLean, BNSF Railroad, the Pilot gas stations they own. They own Dairy Queen wholly. So it's really interesting. It's like an ETF in one. And it's a stock though, but owns a bunch of assets. It's kept up with and actually done, I think, a little better than the actual S&P 500. So yeah, if you're just looking for like a competitor to the S&P 500, check out Berkshire Hathaway. Do you do any swing trades? Not often, but yeah, I like super micro is technically like a swing. I'm kind of looking to get out of super micro. But yeah, I don't normally buy a stock or thinking it's going to go up 10% in a week. And then sell it after the week because I'm never right with my timing. But I like swing trading with shares more than like doing options because you can wait to be right. Okay. We'll do a few more here. Oh yeah, wait, EMR, was that Emerson? Yeah, Emerson Electric. I actually really like this name. Let's go look at their earnings right here. Or actually, I haven't looked at them in a while. So $72 billion market cap. Let's see what the dividend is. So you get a 1.65% dividend, a 50% payout ratio. So final control revenue, quarterly, that's up. That's good. It's growing every quarter, but single digits. So that's up 4% year over year. Control systems, why is it going annual? That's up 7% year over year. Let me just see. Does AI break this down for us, their most recent earnings? No, that's okay. Let's just go down here. So the revenue is, so this probably explains its PE ratio just because it's single digits, 5%, 4, 1, 1. So slow revenue growth, but they're still making insane net income, easily like 500 million plus of after-tax net income a quarter. Wow. Operating profit was 980, but the net income was only 640. Huh. So let's go check out their dividend too, because they do pay a dividend. They made 640 mil in net income, and the dividend cost 300 mil. So yeah, right under a 50% payout ratio for the dividend, and a tiny bit of share buybacks. I don't know. Sadly, like you'd think like Emerson Electric, like they should be benefiting more from like the AI demand, like a Comfort Systems or Amphenol is, but it seems maybe this one hasn't, and that's why it's kind of been flat for a while. I don't know. It looks like they missed on their growth expectations this quarter. Analysts expected 4.89. They only did 4.85. Yeah, they missed on revenue, they missed on net income, and they missed on EBITDA this quarter. So that might explain why they gapped down on earnings and gapped down on their previous earnings as well, because they missed on last quarter's expectations too. Interesting. Can you do Moderna? Hey, what up? 123 Niels. Okay, so MDNA, is that the ticker symbol? Hey, or give me the ticker symbol. Or Moderna, is it mRNA? Something like that. Yeah, okay, mRNA. So this is that COVID vaccine play, and the stock rallied up a bunch because of the COVID vaccine, and now they just don't sell those anymore. And so the growth is gone and the profits are gone, and they sadly deserve to be at their current price. Yeah, dang, they're not expected to make net income for a long time. So yeah, look, here's the COVID revenue right here. Well, it's not going to break it down. But anyway, the growth is gone. If we just go to the revenue down here, look at the past 4 quarters. Look at these year-over-year declines. Like the revenue's down 45% this quarter. Last quarter was down 41. Then it was down 35. Then it was down 65. So the growth is super negative on this name, and not just the top line that's negative, but the net income. So it's a business that's losing a lot of net income every quarter. So if you like Moderna, IMO, a much, much better one to buy on the dip is actually Pfizer. They had the COVID vaccines, but they also own a bunch of different stuff. Like they own Metsera that they bought for $10 billion, a weight loss prescription. They own like Viagra. Well, I don't know, but they own a lot more than just that COVID vaccine. It looks like that COVID vaccine was like literally all the stuff. Okay, but I'd be careful with them. I wouldn't touch them probably. I'm thinking of getting into Meta. Yo, Meta's a great one to buy right now. Not financial advice. Yeah. Someone said, what's your buy price for SoFi? I think in the low 20s. SoFi's so expensive even right now. Like SoFi trades at 60 times next year's net income. They certainly deserve a high multiple, but I think SoFi could go a little lower. And I say that as a SoFi shareholder who's up a bunch. I want to see SoFi do good, and I regret every share I've ever sold a SoFi. I did not expect them to report the numbers they reported. And because the numbers are so impressive, they certainly deserve some sort of high multiple. Like same with Robinhood too. Some of your biggest regrets will be selling out of great companies. Like look at Robinhood. We were buying shares at 8, 9, 10, 11. Then we sold 50 of them, all our shares at $36 for a 3x. And even though I made 3x on my money, I still was one of my biggest regrets. Same with some like SoFi. Anywho, okay. Can you look at TKO? Hey, what up, WGT? So this is a fascinating stock right here. They're like a licensing play. So they own the WWE, the UFC, and they are licensing out those streams to other like streaming, licensing that content to like streaming platforms. But yeah, WWE is 36% of the revenue. They also own IMG Worldwide. Not sure what that is, but yeah, and the UFC, pretty impressive there. So if we go to this is the crazy part. Or actually, if we go to the net income right here, they're actually making good net income every quarter, easily, and that's real. After paying a bunch of taxes, 70 mil taxes, every single quarter, they're making 100 mil plus of net income every single quarter. It's phenomenal. Plus a really, really good balance sheet, to be honest with you. I think since they're now making so much net income, they're confident in it. They just started paying a dividend for the first time ever. So that's so impressive. It's TKO. But what was the forward PE? Or let me check that real quick. Forward PE at 20. Wow, so they're trading at 20 times forward PE. That's why I wouldn't sell out of this name. Even if you're up a bunch, it might just continue to climb higher. Can you? Oh, hey, PayPal. Hey, yeah, let's get to PayPal. We actually just covered PayPal not that long ago, so I've been trying to avoid that one. Oh, WorldCoin. Hey, yeah, we don't really look at crypto on here. And like RGTI, this is another just junk company. Like this is riggedy computing. pure swing trade, pure momentum play, nothing to do with financials and fundamentals. So this is nuts. This company is worth 7.79 billion. I've been in the market for a while. I feel like I know what a $7 billion company should look like. I know Powell Industries is half the market cap. Dave is a fourth of the market cap, and they're doing 50 million of net income a quarter at their three to $4 billion market cap. This is double the market cap, and check out this company. Again, from a fundamental point of view, you just wouldn't buy this one. But yeah, the sales are 1.9 million of revenue. The revenue is 1.9 million, and it's down 18% after it fell 23%. And they're burning through they lost 200 million in net income this quarter. Anyway, this is just some quantum momentum company. You buy them for the swing trade. You're not really buying them to trust in the long run. So Citigroup, hey, what's the ticker symbol? Oh, it's ticker symbol C. Okay. Wow, $170 billion company. They've actually done really good. What's the yield here? A 2.3% dividend yield. That's a safe payout ratio. 36% payout ratio. What's the PE? PE is a 14, or that's right in the industry average. Look at that. Their PE is PE. Yeah, their PE is a 13.88. Industry average is a 13.82. So let's see. Yeah, markets, services, United States personal banking, wealth management. How's that doing? That's at a record. So let's just go down here to the net income. Yeah, this is insane. They're easily making 4 billion of like net income every single quarter. Let's go see how much the dividend cost then. We already know the dividend's super safe, but their dividend cost only, where was this? Dividend cost. Oh yeah, I'm missing. There you go. 1.37 billion a quarter, so they can easily afford the dividend, and they can afford to raise it. I don't think they've kept up as much. I don't think they've done as good as J.P. Morgan and Goldman Sachs though. STX, I think this is Seagate right here. We'll check out Seagate and ASML too. What about Carlyle? Yo, I love both of those companies. You mean FIX? That's my largest holding. I love that name. So here's Seagate Technologies. Actually, I said they have to go right now. We'll probably look at one other stock after this. By the way, if you wanted to follow up on, we stream every day. I sell nothing. I have no course book. And we're actually going to be live in exactly 6 hours from now as well. We're going to do another 2.5 hour stream tonight. But yeah, here's Seagate Technologies. Yeah, we've been live for over 2 hours now, 2 hours and 20 minutes. But yeah, check this out on Seagate. Here's what the AI is saying. Data center revenue accounted for 80% of total sales. So a big data center play, and it was fueled by AI inferencing and cloud storage needs, with HDD shipments up 32% year over year. Seagate qualified Mosaic 3+ terabyte HMAR drives. We're speaking English here, with major cloud providers, and returned 182 million to shareholders. Oh, so they did like some share buybacks or something too, it sounds like. Well, anyway, yeah, let's look at what they reported versus what the analysts expected. So they beat on revenue, a big beat on net income, and a big beat on EBITDA. So it's a triple beat quarter. Yeah, they're easily doing 500 mil. They did 500 million in net income this quarter, and it's expected to grow. And that's going to be 2 billion of net income a year annualized, market cap of 50 billion. So forward PE, yeah, well, my forward PE would be a 25, but the analysts are they're expecting a 20 forward PE. That's why this stock, like, legit might just go higher. That's insane. Oh man. Hey, thanks, Big Ren. I appreciate y'all being here. Do you cover foreign stocks? Yeah, we can. We can view Australian stocks, Canadian stocks, Chinese stocks. Actually, pretty much everything. Yeah, every stock we can. All right, last one we'll hear. Domino's Pizza and American Express. Hey, those are both owned by Warren Buffett, actually. Domino's Pizza has a nice dividend, but they haven't done too well. I'd maybe rather buy a Chipotle over Domino's Pizza. First off, I'd rather own McDonald's stock, and I do. But let's see, what did they say? So U.S. same-store sales increased 5%, supported by promotions and new product launches. Global expansion continued with 214 net new stores, including 185 international locations. So let's go check out the sales. Or supply chain, or let's see, revenue is up 6.2. So revenue's up 6.2, and the net income was 140 mil of net income on that. So 12% net margins. I expected it to go down just because all the margins and all the restaurant stocks are going down right now. Bit of a balance sheet there, but that's somewhat normal for restaurants because if this is a royalty model. And yeah, look at that. Berkshire Hathaway, which is Warren Buffett's company, is the second largest shareholder. They own 8.8% of all the shares of Domino's Pizza. That's actually pretty interesting. Actually, the last stock I'll go over, FIX right here. My largest holding. Hey, thanks again. Wait, who said that? WGT. Okay, so here's Comfort Systems. This stock, I think, first off, I'm not selling or trimming a share of this like ever. Look at this. The forward PE is a 30. A 30 after all the stock price appreciation that it's had. And here's why they deserve that multiple. This is an MEP play, mechanical, electrical, and plumbing play. If we go to their electrical segment right here, it's nuts. I'm a believer that in the coming years, MEP workers, and they're a big HVAC play, electricians, they're going to be in such demand. There's a shortage of these workers right here, and they're returning all the good ones. But yeah, electrical segment revenues at a record, up 72% year over year. And if we go to their main business, mechanical segment, that's up 25%. After grew 39, after 21. But look at the analyst expectations, crazy beat. They beat on revenue by a major chunk. They beat on revenue, they beat on EPS and on EBITDA by such a huge chunk. I didn't believe it. So if we go to the revenue, it's up 35. So the sales are up 35, but the net income is up by 99. So what does that mean in English? That means they're raising prices and expanding net margins. Net margin went from 8% to 11.9. That just adds money to your bottom line. It's crazy. Yeah, every day, gross margins are up 17, net margins are up 50, and they made 290 mil in net income this quarter. Oh, the free cash flow was over 500 mil, but 300 million of after-tax net income, or what was the before-tax number? Before tax was 378 million. The after-tax is 291 million. So 290 million in net income. Let's see how much the dividend costs. It's like so low. The dividend literally cost 17 million. So they're raising the dividend every quarter at such a rapid pace because they can afford to do it. So that's how the dividend went from 60 cents. It was just 50, 45, 40, 35. This is one of the few rare companies that actually raise their dividend quarterly, and it's totally justified. Anyway, I got to go. Or what happens is, hey, what up, Santi? Hey, again, if you want to get this app I'm on, it's in the link tree in my bio, the very first link there. It's a brokerage. It's a software where you buy stocks on. They ask for a bunch of information. Actually, all brokerages do that. And all these apps I'm on, these are all brokerages where you buy stocks on. They're all in the link tree in my bio. If I was going to get a brokerage out of all three of these, if I was just getting started, if you want to get into stocks, I would get this one right here. Very first link in the link tree in my bio. Cost nothing, no commissions at all, completely free. Oh my goodness. Well, TikTok just said it was AFK, so I just had to fill out a CAPTCHA. I wasn't sure where it cut me out at. But anyway, yeah, if you want to get this app, it's in the link tree in my bio. My favorite brokerage. It's free, costs nothing, and it's an affiliate link. So if you go and deposit $100, we'll both get some free stocks. But anyway, I got to go. Hope you have a great rest of your day. We're going to be live in exactly 6 hours from now at 8 p.m. It's 1:53. We're going to be live at 8 p.m. streaming stocks when the market opens. And I'm so curious to see what's going to happen next week. So hope you guys have a great rest of your day. I will see you all very soon. Thanks again. And thanks to everyone on the YouTube replay. Y'all are the best. Thank you so much.